market structure and index composition. And I think the companies that have benefited are, of course, facilitating and allowing society to function, adapt, and prosper. They sit at the epicenter of the pull forward of secular tailwinds, a tectonic shift, really, towards all things digital that is occurring globally.
To identify that growth then, Charles Cantor, where is it on the income statement, or are you trying to identify it through ratios? Where do you discover growth within the accounting?
Look, I think you've got to look in the income statements and follow the investments in the cloud, the investments in R&D, the investments in distribution systems, the investments in people. And when you follow those dollars, you'll note that there was I think on a run rate basis, almost $1.5 trillion spent on tech equipment, software, and R&D. Which is really, almost half the nominal GDP in the second quarter. So there's pieces of this economy that are thriving and that are investing in future growth. Those items, of course, all carry a negative sign to them in the income statement, and so meaningfully underrepresent current earnings, but provide the lifeblood for future growth and future returns going forward.
Charles, how much more of a correction will we see in some of these tech stocks?
I think guessing tomorrow, Francine, of course, is a fool's business and not something I've ever been particularly skilled at doing. But at the end of the day, I think it's the details of the underlying businesses that will always matter. So in the short term, you'll get rotations. I think they're exacerbated by market structure and the composition of indexes, where folks run from one side of the boat to the other side at really breakneck speed. But at the end of the day, and of course the market will create an ETF for whatever trade you want to put on, whether it's Biden versus Trump, whether it's stay at home versus back to the office, whether it's value versus growth, you can find it. But the opportunity, of course, for the active long-term oriented investment professionals really focuses on the details and focuses on the companies. And our focus has been exclusively on what we call beyond privileged and resilient companies. And they prosper because of the combination of growth and the flexibilities of their balance sheets. They enjoy unbelievable competitive advantages because of their network effects and intellectual property. And they have the balance sheet to withstand stressful times and rogue waves that arrive when we least expect them. And so for those that have somewhat of a longer term view, we think growth wins out. In the shorter term, I think it will be dependent on how you think this election plays out. And I'm happy to, give your viewers a sense of that.
Yeah, Charles, I was going to actually ask you about the election. First, how much volatility are you expecting into the election? And if you look at some of the concerns that could hit some of the companies that you like, is the biggest concern the U.S. election, so not calling it right, or is it a second lockdown, or is it U.S. trying to trade?
Look, I think volatility is good for those that understand assets. I think it would be foolish not to include, all of those items in your mosaic for those that are trying to get shorter-term market direction. But to me, I feel the setup for Election Tuesday 2020 feels remarkably similar to 2016, where we got comfortable with the slow and low environment, and Hillary was the assumed presidential winner. Go back and look at rates in 2016. I think rates, 10-year Treasury started at 2.25, bottomed closer to 1.6, 1.7, and then post the Trump unexpected victory, rates soared to 2.6%. At the time, I described the presidential victory as one of the few times in my life where I saw uncertainty, Trump uncertainty, and the market actually liked that. And there was anticipation, of course, of more real growth, less deregulation and lower taxes. This time around, it feels kind of the same. We started the year with Treasury yields at 1.9 on a 10-year basis. They're now, of course, 68, 70 basis points. And Biden's expected to be the president from the view of the market. And the Republicans are expected to lose the Senate. So in that environment, of course, slow and low works, growth works. But if you get an unexpected result, and you're betting on Trump, you're going to want to own for the shorter term, of course, value stocks. The Trump has one less arrow in his quiver, of course, because he's already played out the deregulation. I suppose he's left with lower taxes. But the setup feels like if you get an unexpected result, much like you got in 2016, for that moment in time, you're going to want to own value, and then longer term, you're going to come to realize we remain in this kind of asymmetric growth environment where growth's going to be hard to find. The Fed put is in, and businesses that are benefiting and enabling society are going to continue to prosper.
Charles, thanks so much. Charles Cantor there of Neuberger Berman stays with us. Now, coming up in the open, Mike Wilson, Morgan Stanley Chief U.S. Equity Strategist. He'll field a couple of questions on tech from our Jonathan Farrow. That's at 9 a.m. in New York, 1 p.m. in London. And this is Bloomberg.
We are above forecasts. 1,800,000 jobs is the total non-farm payrolls, with 17,000 additional jobs added in terms of net revision.
You still got 1.8 million with a big decline, almost a full percentage point drop in the unemployment rate, which will move to single digits easily in the summer and fall.
Leading up to this data, there was a lot of reason to suggest that the pace of increase had slowed. And in fact, what we see in this data is, of course, it has slowed. But the good news is that it is continuing. And it is continuing despite some slowdowns that we're seeing around the country as a result of an increase in cases.
People tend to focus on the growth rate. The big issue is the depressed level of spending and income in the economy, which is reflected in the level of the unemployment rate of around 10%.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
We've put ourselves on the front foot again by adapting all the company, by resizing, by adjusting production rates, by adapting the supply chain as well to this new difficult environment.
Good morning, everyone. Bloomberg Surveillance. Francine Lacroix in London, Tom Keene in New York, Tiffany in LVMH. LVMH has come out with a terse statement saying they will not move forward with their acquisition of Tiffany. James Fontella-Khan in the FT moments ago publishing an article, Tiffany taking legal action against LVMH, claiming the conglomerate has deliberately stalled the process of securing antitrust approvals for its $16 billion takeover. We'll have much more on this through the morning. This is turning into a real battle. Charles Cantor with us with Neuberger Berman. Charles, is there value for you under your growth parameters in luxury fashion? I mean, the total returns of the conglomerates has been quite good.
Yeah, we don't have a specific view on luxury. Of course, they've benefited globally from the wealth effect. But I think the Tiffany example is a reminder that management teams need flexibility. and the outcome makers, possibly like LVMH, will go to the end of the earth and back to create flexibility, even if it means walking away from the prized light blue box, so to speak. Don't forget, Tiffany's business is very dependent on the store in Midtown New York, and of course, that's not really open, and the tourists aren't really arriving. And so I think LVMH is being brave. Of course, material adverse clauses are going to be tested against COVID as being an acceptable reason to walk away from a deal. But at the end of the day, I think the shareholders of LVMH will applaud this decision to be tough and ruthless as it relates to capital allocation and capital structure. And candidly, this is the environment where you want to dig down into your management teams and make sure that they've been run by people that are seeking continuous improvement and building flexibility in their balance sheets and their capital allocation strategies to handle the uncertainties that can always arrive, and certainly arrive when one least expects them.
But Charles, what is this story about, that you can't sell jewelry online, or that it's just a very difficult time to, figure out consolidation to grow a company?
I think when you pencil out numbers in an environment where your customers aren't arriving at your stores and you're so dependent on global travel and wealth, it's a tough exercise. And so what you assumed before the rogue wave arrived versus what you assume now versus the trajectory of how the business returns is an incredibly difficult bet to make if you're a fiduciary in the boardroom of LVMH, and given the size of this capital allocation endeavor.
Charles Cantor, thank you so much. With Neuberger Berman this morning, just wonderful perspective there on growth. And a key paragraph in the FT story, and this is according to people close to the matters, Tiffany will file a lawsuit with the Delaware Court of Chancery on Wednesday, seeking to force LVMH to close the transaction by the November 24 deadline. So a spirited battle here from a number of news sources. Bloomberg making very clear that LVMH will not move forward with the acquisition. We'll have much more on this as well. Futures up 28, Dow futures up 153. Coming up on Bloomberg Surveillance, David Kelly of JP Morgan Asset Management. This is Bloomberg. Good morning.
Nós aqui do Brasil, eles querem proibir nós na mineração, produzir a mineração, né? E vem as empresas, grande empresa que nós aqui do Brasil não tem condição de trabalhar nela, eles pegam, tiram o minério e levam quando eles querem. E nós no Brasil aqui, que mora aqui no Brasil, nascemos no Brasil, e fica sem nossa coisa.
Sou pai de família, né? Eu tenho filhos estudando. E eu não posso me acovardar ao ponto, né, de deixar minha filha passando necessidade ou a minha esposa passando necessidade. Então a gente se precaver, vai fazer o quê? A gente vai esconder, a gente vai correr deles, né, enquanto tiver perna. Agora desistir nunca, a gente vai continuar trabalhando, porque eu preciso sobreviver, eu preciso dar o sustento para minha família.
When everything around us, including the way we work and live, has been interrupted, uninterrupted service is peace of mind. Kimmy from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
This is Bloomberg Surveillance. Dom and Francine from London and New York. Now, the LVMH board considers it cannot carry out a Tiffany transaction. That's a fancy way of saying that actually they no longer, for now, want to buy Tiffany. Let's get our expert on this, Deborah Aitken. She is Senior Luxury Goods Analyst from Bloomberg Intelligence. Deborah, a number of stories out there. One that Tom was also mentioning to us, saying that, Tiffany was saying that LVMH was dragging their heels over this takeover and wanted to sue them. And then LVMH suddenly saying, actually, guys, this is not going to work for us. Do we understand the underlying reasons of why LVMH is walking away?
So we have a document which was released in French, and the content of the document is stating that Tiffany has requested an extension from that 24th of November deadline, which was already a 3-month extension on the notice of outside date extension from August the 24th. And from my understanding on the document, it would be November the 24th would be the date whereby LVMH would then not have any legal reason to stay within the deal. So Tiffany is asking for the 31st of December, and the French Ministry of Europe and Foreign Affairs has requested the 6th of January as an end date. From what I understand, LVMH doesn't have to go to that. So from what we can see initially, we don't think it's breaking a clause. If it goes to November the 24th and it just doesn't happen, it means that LVMH to me walks away free and comes back again.
Deborah, I'm really I'm really able in this area in that I've watched The Devil Wears Prada 3 times. So help me here. What's the relationship of these two managements over the last number of months? Is it acrimonious like The Devil Wears Prada, or have they gotten along in trying to battle through a pandemic?
I think generally they've gotten along in trying to battle through the pandemic, and LVMH has always stuck by the rules and said, we've entered a deal, we'll see it through, we're long-term purchasers. Tiffany is a good product, it has a place in our portfolio. And I know that when Tiffany initially asked for some extension dealing with one of the Australian boards, that was granted back up to April 5th or 6th, if I remember the date there. So there has been some working together on this deal for sure.
But, Deborah, what is this about? Is this U.S. tariffs? Is this about people not going to New York and therefore not going to the Tiffany store on Fifth Avenue? Is this people not shopping? And so, can you sell luxury jewelry online? What's the underlying reason why they no longer want to be part of this consolidation?
I think for them, I do see that Tiffany makes sense for LVMH. I do see that they wouldn't have big competition in coming back and bidding again. It may be that there becomes more of an acrimonious relationship. But no, I think that if we look, Tiffany's back to profit in the second quarter to July. Sequential monthly sales trajectory has improved. The U.S. consumer generally is strong, and the ideal really for LVMH with Tiffany was that it did a lot in Asia and moved up in price points, which I think is still part of the longer-term proposal.
Yeah. Deborah, we got to leave it there. Deborah Aitken, on very short notice, expert on branding, her work at West LB over the years. Thrilled that she's with Bloomberg Intelligence. Another headline out in the cacophony, the soup of headlines on this, and so much of this coming because the release from LVMH is in French. Francine helping there, me not. The Minister of Europe and Foreign Affairs asked LVMH to defer acquisition beyond January 6th of next year. C'est formidable, say Bloomberg.
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
I do double down on helping other Black founders, whether it's fundraising, hiring, growth, product, whatever it is that they need.
The Boston Symphony Orchestra presents BSO at Home, a collection of concerts, at-home lessons, and behind-the-scenes stories to enjoy while you stay at home. Learn more at bso.org/at-home.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
What they have is so meager that it insults the intelligence of the American people, does not solve the problem, and it is not. Again, we know that we have to compromise. We know we have to negotiate in order to reach an agreement. We all want an agreement. Make no mistake about that. But get serious. Get real, Mitch McConnell.
Good morning, everyone. Bloomberg surveillance from London, from New York, the Speaker of the House there, and of course, lots going on this morning. The Tiffany LVMH blow up, where we're looking at that right now. Francine Lacroix in search, and I say in search, of the French version of the LVMH release. We'll see when we get the only version, and we'll see when we get that. Right now, not speaking in French, hopefully in fractured English, Kevin Cirilli, our chief Washington correspondent. Kevin, in the short time we've got with you today, what will you expect to see today from the Trump campaign and from the Biden campaign?
Well, two things. First and foremost, we're all awaiting what type of energy policy proposal Democratic presidential nominee Joe Biden is going to unveil today. He says he's going to have some incentives from keeping businesses from going offshore. However, I think the second point that I would make here is that for President Trump, it is a continuation of going tough on China. You saw that in his speech where he used the word decoupling on Monday. And based upon my reporting yesterday, how now there are several businesses in the Xinjiang region that are going to find it much more difficult to import into the, or to export rather, into the United States because of the human rights abuses against the Uyghur Muslim minority group. Either way, China, and what typically is a geopolitical pause in an election year, China is now front and center of this presidential election.
Kevin, how difficult is it for Joe Biden to actually set the agenda of what he wants to talk about? Does it feel like he's constantly following the president? So the president makes a statement, for example, on U.S.-China, and he has to state his policy.
Yes, and I think in terms of what you've noticed from private citizen Donald Trump to candidate Donald Trump and now, of course, to President Trump up for re-election is that he knows how to set the parameters of a debate. Where the Democrats were somewhat successful in pushing the Republicans on defense was over the weekend as it relates to Veterans Affairs issues. However, the Republicans issued a very well-orchestrated response in terms of having individual after individual refuting that Atlantic report. But this is now the final sprint, fourth quarter, so to speak, to November 3rd.
Kevin Cerulli, too short a visit today. Thank you so much, our Chief Washington correspondent. Right now, an important interview on technology and on engineering. He is without question the most qualified person in Washington within the Trump administration to speak on technology. He is Keith Krach, and we know this because Mr. Krach grew up with a father with a welding gun in his hand, and it is well understood that if your father's a welder, you have a different view of life. Of course, affiliated with Purdue University, Mr. Krach, serving the president, is Undersecretary of State for Economic Growth, Energy, and the Environment. Keith, good morning. Welcome to Bloomberg Surveillance. I want to talk to you about what we know about Chinese technology. Can you tell us, do we have knowledge that the engineering and technology of Chinese products are actually a threat to Americans?
Well, Tom, first of all, thanks so much for having me back. It's good to be back on your show. You know, we do. And, you know, you talked about my background growing up in Ohio. You know, I was able to see firsthand from my father's smallest machine shop the implications for weapons of mass production. When I was a vice president at General Motors, I could see that if you built a plant over in China, that you weren't just giving your blueprints, you were teaching them the process engineering, and you were training their people. And then after 30 years in Silicon Valley, I've had my intellectual property stolen multiple times. It's the reason why I came to the United States State Department to serve the country. And now, from what I see from this vantage point, it is way worse than I could have ever imagined.
Do we have evidence that there's been violations around national security in Chinese analog and digital technology?
There absolutely is. You know, if you look at what the Communist Party has done, is they've created a surveillance state inside of China. Earlier, you were talking about Xinjiang. And you know, these are surveillance tools that dictators of the past could have only dreamed of. And, you know, I think citizens of the world are waking up to the Chinese Communist Party's three-pronged strategy of concealment, co-option, and coercion. The pandemic is a result of the concealment of the virus. They've totally co-opted Hong Kong by eviscerating their freedoms, and coercion of the worst magnitude in these internment camps in the west of China with the Uyghurs and all these other Muslim groups. And what they've done is they've exported that forced labor all over China. So, and then you look at this surveillance state. Now what they're doing is they're extending that, you know, what I call the great one-way China firewall, where all the data can come in for their AI purposes and their social credit score, but none can come out. And reciprocally, from a propaganda standpoint, all can go out, but the truth cannot come in. And it is a real and urgent threat to democracies around the world, Tom.
But Undersecretary, I mean, is this, is this about basically China not respecting human rights and so punishing them, where it hurts most, i.e. technology, or is this, real concern that the technologies that we use that has come from China is spying on us? Like, what damage does it do for us, for me, for you, for Tom?
I couldn't hear all your question, but it's much more than human rights. They have a thing over there they call civil military fusion. And so what they've been doing is for the last 30 to 40 years, they have been stealing intellectual property. They've been buying up things under the radar. Any way they can get their hands on it. And I just wrote a letter to all the CEOs in the United States. I also just sent one to all the governing boards for all universities in the United States. And I talked about that for the university. I talked about that real and urgent threat to ensuring academic freedom, to honoring human dignity, to protecting intellectual property, but also protecting their endowment funds, because many of these endowment funds have invested in Chinese companies that are on our entity list. When you're on the entity list, traditionally there's export controls. They've been turning this over to the Chinese Communist Party, the PLA. And I didn't know until I came out here that China actually had a National Intelligence Act that requires any Chinese company, state-owned or otherwise, any Chinese citizen, to turn over any information, proprietary technology, intellectual property, or data upon request to the PLA or the Chinese Communist Party, or suffer the consequences. And I think we know what that means.
Okay, what exactly does it mean? So, do you have proof that they use TikTok or WeChat to spy and using that data linked to a person's name?
Yeah, I mean, if you look at application, and by the way, it's more than just those two applications, but if you look at those two, I mean, they can see all the data. Of course, people talk about you can be blackmailed with that. I mean, they spy on, I have 5 kids. They can see everything they have. But they also take all that data and they put it in their AI machine. And what it does, it'll crunch out what they call over there a social credit score. So they quantify one number, and that one number means how loyal are you to the Chinese Communist Party. By the way, they can do that. They're doing it with U.S. citizens, U.S. companies as well. And so, so they can look at it and go, well, who from the United States could we get to be a close ally for us? Or who could we turn? So these have big implications.
Mr. Undersecretary, you mentioned you have 5 kids. I would assume Mulan was downloaded at the Kroc household over the weekend. There is an uproar about the Walt Disney Company using facilities of the Communist Party in Western China as they affected those beautiful scenes. And we can all agree the art, particularly the opening desert scene of Mulan, is just extraordinary. Do you and does the president have a view on Walt Disney using services of the Communist Party to make this movie?
You know, Tom, I actually saw the movie over Labor Day weekend with my 8-year-old twins. And when I heard this, and by the way, I didn't hear it until after I watched the movie, it's really sad because if they're using this forced labor from Xinjiang, where they have them in internment camps, and they do everything from sterilization, forced abortion, torture, sexual abuse. They make them take all kind of drugs. It's just, it's gotten out of control. And so if you look at the Chinese Communist Party, it's infiltrated our businesses, our universities, healthcare, definitely Hollywood. And you know, what's interesting now is I think because of the pandemic, citizens of the world have woken up to their strategy, and they don't like it. And as a consequence, I think government leaders and corporate CEOs are beginning to stand up to that
Mr.
China
Secretary, this is critical, and we're going to run out of time. I'm so sorry. Should the Walt Disney Company be punished because they utilize those services?
Well, I think those kind of decisions are up to the president. But I can tell you one thing, that when you look at combating China's aggression, this is the most passionate, unifying, bipartisan issue of our time. I mean, when you go to the Hill, it's solid. Democrats and Republicans alike are united on this issue.
It's a scary thing. You say you have twins. That means one has to go to Purdue and the other has to go to the University of Indiana. These are tough decisions. Mr. Undersecretary, thank you so much. We really appreciate it. Keith Crock, of course, and his leadership at, we should mention, Purdue as well. There's also leadership in the legal area, and it is right now Bloomberg confirming that Tiffany sues LVMH and Delaware Court to enforce their combination. This is a battle. The headlines coming out furiously right now. We'll have much more on this through the day. With our first heard news in New York City, here's Ritika Gupta.
Thanks, Tom. Senate Majority Leader Mitch McConnell says the new Republican stimulus plan focuses on restoring supplemental jobless benefits and extending help for small business. The Senate votes on the measure tomorrow. It will cost as much as $700 billion. That's about a third of what House Democrats want to spend. Joe Biden opens a new front on economic issues today. The Democratic presidential candidate heads to the battleground state of Michigan. There, Biden will unveil a new policy aimed at fighting offshoring. That's a practice of U.S. companies basing some operations in low-tax countries. Polls show that voters are starting to trust Biden's approach to reversing job losses. And AstraZeneca has paused its coronavirus vaccine after a person taking part got sick. That could delay efforts to speed an immunization. The drug maker says a trial's participant developed an unexplained illness. The pause will allow research to examine safety, data, and maintain the integrity of the trials. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Tom Francine.
Ritika, thanks so much. Now, coming up next, we speak COVID-19 with Lauren Sauer, Johns Hopkins Assistant Professor of Emergency Medicine. We'll talk about this AstraZeneca trial now put on hold. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news analysis and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market, it's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Good morning, everyone. Bloomberg Surveillance, an eventful day as well. Francine Lacroix and Tom Keene were watching Tiffany and LVMH simply blow up, is a professional word. Of course, AstraZeneca with some real challenges with the vaccine. Sam Facili just brilliant on that an hour and a half ago. Thank you, Sam, for the early morning view. Right now, we continue forward on the pandemic with Lauren Sauer with the Johns Hopkins University, their assistant professor of emergency medicine. Lauren, you know in the science of vaccines, there's lots of failure along the way. Give us your timeline. I don't mean the punditry. I don't mean all the non-pros. When do you expect that we can sort through the failures to come to a success on vaccine?
I think we're going to see a success in vaccine sometime next year. I am not as optimistic as some of the other people who are talking about a vaccine, you know, by the election or by the end of this year. I think we're seeing some really good data out of these vaccine candidates. There's 9 in phase 3 right now. But I think we do have some time where we're going to have to wade through some of these data and better understand how well the vaccines are working and what the priority is for manufacturing.
Are we going too fast, Lauren, in trying to find this vaccine, or there will be hiccups, but actually it will be safe when it's out?
I think there's elements that are moving a little fast for my liking personally, but I think the news over the weekend of the vaccine makers led by Pfizer and Moderna and AstraZeneca to pledge safety over speed was a really important step. It's a little bit of a worrying step, I think, because the fact that they felt that they needed to say that we're prioritizing safety means perhaps that they were being pushed to speed up the timeline. Everybody wants a vaccine. A vaccine is an incredibly important tool in our toolkit, but we need to prioritize safety. So I think seeing that step by the vaccine makers was really important.
Lauren, what does it mean in terms of what they're worried about? Is the worry that we have a vaccine that's not safe, or is the worry that we have a vaccine that's safe but that nobody actually wants to be injected with?
Yeah, I think it's some combination of the two. I mean, I think these phase 1 trials, they start with safety. So we understand the safety profile before we even start to understand the efficacy of the vaccines. But here in the US, for example, we have a vaccine hesitancy problem. So it's not just rolling out a vaccine that's safe based on clinical data. It's also really important to understand what will stop people from taking it, what will encourage people to take it, what are the safety and efficacy data that people, the public, want to see in order to ensure that they will go and get that vaccine. Because if we create a perfect vaccine but no one wants to take it, it doesn't matter.
I mean, because of this unexplained illness, which paused AstraZeneca to stop the trial for now, to suspend the trial, does it mean that it will also be much more difficult to get people, healthy individuals, to try out future vaccines for COVID-19?
I think that people should actually be happy to see that this is happening. Normally, I think that this wouldn't make national news, but because this is such a national and international priority, this is a standard process in both vaccine and therapeutic creation and production. We stop trials when we see something concerning or unexplainable, something that doesn't align with the data we saw in phase 1 and 2. And so this is AstraZeneca doing their due diligence, looking at this adverse event, looking at what happened to this person who had an unexplained illness, going back through their data to see if perhaps they saw it elsewhere.
Thank you so much, Lauren Sauer there of Johns Hopkins. This is Bloomberg.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
Europe does, as you say, have some catching up to do on that front. So we are expecting to see a little bit of strength coming through at the start of trade. How long will it last, though? The perennial question.
This is Bloomberg Surveillance. Tom and Francine from London and New York. Now, earlier this year, Netflix co-chief executive Reed Hastings announced that he and his wife would give $120 million to fund scholarships at historically black colleges and universities. He discusses the donations with David Rubenstein on the latest episode of The David Rubenstein Show, Peer-to-Peer Conversations.
You and your wife recently made a contribution to United Negro College Fund and to Morehouse College and to Spelman College. Why did you decide to do that? Is that not your largest philanthropic contribution, any one gift?
No, it's not the largest, but it's the loudest, or sort of the most public. We tend to mostly be very quiet about these things, but we wanted to show solidarity for Black education, and Black education is so critical to economic mobility, political mobility, and the sense of belonging. And the challenge, for us as a culture is really the legacy of slavery. And it continues to be a tremendous scar across the soul of America. And it's, awful, and it's so bad that it's hard to look at and talk about, and it's so hard to look away. And we really haven't come to terms with the legacy of slavery in our country. So this, modest donation, again, relative to the needs, is really about, Black economic gains and education.
So the story that I read was that you were originally considering a gift of maybe 1/10 that size, and then the last minute you increased it. When you called the head of the United Negro College Fund, was he surprised, or what made you change your mind?
Well, I've known the head of UNCF for a decade, and he's taught me a lot about race in America, and we've been a donor for a number of years. But it was really the current time that got us to make such a substantial and frankly public donation to, again, bring attention to the role of the HBCUs, the historically Black colleges and universities, like Morehouse and Spelman, and to support their work, because they do develop thousands and thousands of Black leaders throughout this country. And they're a really positive part of our education system. And because white capital tends to flow to white organizations, there's relative capital isolation in the same way that we have social isolation. And so, we wanted to be part of building those bridges.
Now, the industry that I've been in, the financial service industry, is not replete with as much success as it would like in terms of minority hiring. And the technology industry is probably somewhat that way as well. Is there something that you can do at Netflix to enhance your minority hiring among the executives and your other employees?
Well, we publish the data, and we've made every quarter, and we've made great progress, and we've doubled our number of African-American employees over the last 3 years. And, that's throughout the business, but in particular in the media side. Our tech side is still underrepresented, as is in the field. So we have a long way to go, but we're, trying to make those efforts, not only, again, for African-Americans, but for many underrepresented groups, both in America and, frankly, around the world.
Well, that was Netflix co-founder and co-chief executive Reed Hastings speaking with David Rubenstein, and you'll hear more from the man behind Netflix tonight, 9 p.m. in New York, that's 7 p.m. on Thursday in Hong Kong and London on the latest episode of The Rubenstein Show. Coming up, more Bloomberg surveillance, but this time simulcast. This is Bloomberg.
Some things you see coming, some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
This is a step in the right direction. Perhaps it's a harbinger for more changes in the future, like the completion of the banking union.
Term is not looking good right now in terms of the support for consumption.
This economy is dynamic, but not dynamic enough given the shock that it has received.
This is a different correction than certainly we've seen in the past.
Any sort of sharp move higher in yields is when I think I see the Fed coming in, putting a lid on how high yields can go.
So I think we're all focused on that September Fed meeting.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
From New York and London for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance Live on Bloomberg TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. With equity futures bouncing back up 23 on the S&P 500. Tom, a little bit of calm after the NASDAQ storm.
A little bit of calm, John. It's not risk on. You don't have higher bond yields helping out, really signifying the enthusiasm. But I like the idea of calm, and maybe, John, I would say stability as well. Remember, NASDAQ 100 down 11%. Yes, that's a correction. The Dow down only 5 or 6%. That's not a correction.
A correction amidst a massive rally, and you threw the Dow in there just to throw me off. I know you did, Tom.
I did.
In the bond market, 70 basis points is your yield on a 10-year. I love you too.
I'll get you something
later,
from Tiffany's.
maybe in a commercial break. Okay, I look forward to that. Lisa, some data coming later.
Yeah, we're going to be getting at 10 a.m. I'm very curious to see what the jobs picture is going to be, because to Tom's point, this is not a full-blown recovery where people are looking at a risk-on feel in the markets. We're going to get the July JOLTS job openings data, which really is a leading indicator for employment growth. At 1 p.m., the U.S. is selling $35 billion of 10-year notes after what Jefferies has called buyer fatigue, which we have seen in some T-bill issuance recently. Also today, Congress is going to be taking a look at the U.S.-China Economic and Security Review Commission. They're holding a public hearing. Very interesting to hear what the bipartisan proposals will be or could be about legislation to potentially penalize China for transgressions that, but really are, again, I want to emphasize the bipartisan aspect of this, John. You've got President Trump coming out against TikTok and WeChat, and former Vice President Joe Biden coming out today with a proposal to levy taxes on U.S. companies that outsource jobs to China.
And a love letter from the Walt Disney Company, Tom Keene, that you did not miss, and has got hugely controversial in the last 24 hours.
Yeah, absolutely, no question about that. We just spoke to Keith Kroc of the Trump administration. He made very clear he folded the entertainment, the theater, the intangible debate into China as well. I mean, all of this is really, really important, and he put front and center. His last comment, John, was critical. He said everything he sees in Washington, this is a bipartisan issue of how the Disney family used the Chinese party in Western China for the making of Mulan.
I'm so distracted this morning. You and I have been too nice to each other a couple of minutes into this program. Shall I do a market check? Get some price action.
Let's do a market check, but Lisa nailed it with a JOLT survey there. This is a big deal today because the jobs just aren't there. Axios with a brilliant study this morning with the great Jed Kolko. John, the jobs aren't there for the unemployed.
That data coming a little bit later. Here is the price action this Wednesday morning. Equity futures drifting higher, up 20 on the S&P 500. A rebound on the Nasdaq too. Euro dollar 24 hours out from President Lagarde and an ECB decision and news conference. 117.54. We come at another 0.2%. And Tom, there it is. You mentioned it in the bond market. Yield's not doing a lot. 0.67% after a big rally just yesterday.
Yeah, the banner for Global Wall Street here is this is not a risk-on rally, as John mentioned at the beginning, folks. It's much more about a calm and stability after the carnage we saw yesterday. John?
The discipline to maintain discipline. The message from David Kelly at JP Morgan Asset Management, the chief global strategist. He joins us now. David, build on that. What do you mean by that?
Well, I think that we're in a recovery, but this recovery is about to slow down. I mean, the sound that you hear outside is screeching brakes because this V-shaped recovery is going to slow a lot in the fourth quarter and into early next year. And I think it's important not to just to pile into momentum stocks. We've seen the stock market do wonderfully well this year, but there are parts of the stock market which have frankly done too well, given the amount of uncertainty out there, and given the fact that down the road we are looking at higher taxes and higher interest rates. So I think it's very important for investors at this stage to be disciplined, realize that just because we've seen some good economic numbers, because the market has seemed to be okay here, don't take your eye off the ball. Recognize that we've still got a long way to go before this pandemic is really over.
Within it is the idea of what the return will be. All the actual assumptions, David Kelly, has been we're supposed to invest for single-digit return. Yeah. Nobody believes that that's on these high flyers. Do we go back to a single-digit world?
We have to eventually, because in the end, it's about nominal GDP growth. And what's happened for a long time, actually for decades now, is we've seen the value of financial assets in the U.S. rise much faster than overall nominal GDP. But ultimately, it's about the growth in goods and services produced by the U.S. economy. And so there is going to be some correction along the way here. And we are going to see a return to single-digit returns. And so it's very important for people, look at valuations carefully, because the things that are most overvalued are the things that are going to get hurt the worst when there is a more significant correction.
Well, David, when you talk about how we could see a correction in what? In tech stocks? Because right now we're seeing an ongoing performance, at least for today, a return to the underperformance in small caps, in financials, and tech is what's recovering.
Well, yeah, and because this market is very momentum driven. I mean, I think this year has been so difficult for fundamental analytics. I mean, how do you figure out what these companies are really worth and the sort of world we're looking at post pandemic? So I think investors are just jumping into the momentum trade here. But when we get through this, when we have a more normal economy, as that begins to shape out, and we have a sense of it in 2021 and 2022, I do think that value stocks should do better than growth. Growth is very expensive relative to value. It's the most expensive it's been since the tech bubble. I also think that international ought to do better than the U.S. A very similar story. Both EM and developed country international are cheaper than the U.S. So I think you need to think about the boring middle of the market here and try not to be too enticed or enamored of high-tech, large cap, mega cap growth stocks.
Oh, David, fold your economics in here. Kasman and Feroli, your economists, make very clear they have a very cautious view out. Is that cautious view folded into fourth quarter, or is that a cautious view for next year?
It should be in the fourth quarter if we're looking at quarterly GDP. We saw GDP fall by 32% in the second quarter. We think it could rise by as much as 30% in the third, annualized, but then only rise by about 3% annualized in the fourth. So there's a very sharp deceleration in growth. And you're going to see that in jobs. I mean, if you look sequentially, okay, we added 1.4 million jobs last month. That's good. But we think that job growth will now decelerate to about less than 1 million per month, which sounds okay, except we're still 11 million jobs short of where we were in February. So again, a deceleration there. So I think in the monthly numbers, it's upon us. In the quarterly numbers, we're going to have to wait for the fourth quarter to see that deceleration.
What's the run rate on nominal GDP that you then fold into your forecasting of the equity markets?
Well, it's hard to talk about a run rate in either 2020 or 2021.
Agreed.
When you get, but once you get into 2022, we're looking at something in the order of 4 to 5% once we get back to close to full employment. But you're going to be, we'll have to bring that unemployment rate down for a while here. But we've got another problem, which is that we've got a demographic crash going on right now, which is also going to take something out of GDP growth when this pandemic is over.
David, what do you make of what's happening in Washington at the moment?
It's all politics. I mean, I think that I was hoping we'd see some sort of new support package, a phase 4 deal before the conventions, because honestly, there are a lot of unemployed people in this country who need that. A lot of people are going to suffer through this winter, but nobody wants to make a deal at this stage, it seems to me, before the election. So hopefully after the election, however it goes in that lame duck session of Congress, we'll have something to support people who just can't get back to work until the pandemic is tamed, and hopefully we'll tame the pandemic in 2021. But for right now, it's just partisan posturing because everybody's focused on the election.
David, is no deal or a very skinny deal priced into the market currently?
I think it probably is. And remember, we're talking about 8 weeks. I mean, we're talking about or perhaps 10 weeks. But once the election is over, I think there is a majority probably in Congress for some sort of skinny deal. Because after all, on things like state and local government, you can come back in January with a new Congress. And if depending on how that shapes out, you could do something then. So you just need to do something about the unemployment support. You need to do something to try and help these small businesses.
Yeah.
But it's you don't need to spend a fortune right now, because you can always come back next January and do something bigger.
David, just a comment on the language that we're using at the moment. A skinny deal is now something between $500 and $700 billion down in Washington. What are your thoughts on that?
There are no fiscal hawks left. There are no monetary hawks left either. I mean, the hawks have all left Washington, which is a little worrying. We do need to do this right now, but I am very concerned that as the economy recovers, particularly if we get a good vaccine and it begins to move forward fast later next year, we've got a lot of government debt, and this is going to be a time when we need to be really disciplined in terms of policy, just to maintain the credibility of of treasury bonds and credibility of the currency. So we're going to need to have some discipline down the road. But I have no problem with spending money right now, because there are a lot of people who are really in some distress, and you're not going to create inflation in the middle of an economy with almost 10% unemployment.
David, great to catch up. As always, stay well. Send our regards to the team. David Kelly there of JP Morgan Asset Management. Tom Keene, a deal between $500 and $700 billion, a bill, maybe the better word, emaciated. The words from the Democrats, an emaciated bill is now something between $500 and $700 billion. Tom, this pandemic has completely changed the way we look at fiscal policy down in D.C. and maybe forever.
Well, there's no question about it. I don't know about forever, but, I like what I'm seeing in notes, including Greg Valliere and others this morning, which is, where is Mr. Biden on this? You wonder when the vice president is going to weigh in and either agree with Speaker Pelosi on a hardline stance against Republicans, or maybe he gives way to some surprise compromise before we get to the election. It's all up in the air, of course.
Well, where's the president on it, Tom? Do you think he's comfortable with how this is playing out? We caught up with the administration the last week.
He needs
they
a bill
comfortable.
desperately. I think he needs a bill desperately. It would really.
Tom, I don't sense the desperation. I don't sense the urgency. I don't sense either.
I don't know. Again, the distance is here. What are we talking, John? 500 billion versus 2.2, right? That's a big
something
gap.
Like that.
Yeah,
the Democrats said they'll come to 2 trillion. Republicans down to 5. The gap's narrowed. It's still $1.5 trillion, though, Tom, and that's the problem.
And this is important, Lisa, very quickly here. I mean, we're going to go to break here, but John, state and local here is absolutely critical to layoffs to come.
And that is not in this Republican bill right now, Tom. Equity futures positive, up 18. A little bit later, conversation you do not want to miss. Mike Wilson and Morgan Stanley. Looking forward to that at around about 9 Eastern. From New York and London, this is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. Senate Republican leader Mitch McConnell is setting up a vote tomorrow on his party's latest virus relief bill. It's a so-called skinny proposal designed to break the logjam with Democrats in the House. The Republican bill will cost up to $700 billion. That's a far cry from the Democrats' $2.2 trillion relief package. Once again, U.S. infectious diseases chief Anthony Fauci is countering something President Trump has said. This time, Fauci says it's unlikely that a coronavirus vaccine will be available by Election Day. President Trump has hinted that a vaccine could be ready by then. That has skeptics concerned that politics will influence regulatory decisions on immunizations. And in the UK, Prime Minister Boris Johnson will ban all social gatherings of more than 6 people. A surge in coronavirus cases to 3,000 per day is prompting Johnson to act. There will be exceptions for organised sports, plus for people getting together for work, weddings and funerals. And bond market guru Jeffrey Gundlach says high-yield debt default rates may almost double. The manager of Double Line Total Return Bond Fund says the Fed's policy actions are distorting asset values. Gundlach's views reflect broad skepticism about the market's connection to economic realities. And French luxury goods maker LVMH is calling off a $16 billion deal to buy Tiffany. The board blames a U.S. move to impose tariffs on French goods. And it comes after Tiffany pushed back the closing date from the November target. Shares of Tiffany plunged in the pre-market. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
We are above forecasts. 1,800,000 jobs is the total non-farm payrolls, with a 17,000 additional jobs added in terms of net revisions.
We still got 1.8 million with a big decline, almost a full percentage point drop in the unemployment rate, which will move to single digits easily in the summer and fall.
Leading up to this data, there was a lot of reason to suggest that the pace of increase had slowed. And in fact, what we see in this data is, of course, it has slowed. But the good news is that it is continuing. And it is continuing despite some slowdowns that we're seeing around the country as a result of an increase in cases.
People tend to focus on the growth rate. The big issue is the depressed level of spending and income in the economy, which is reflected in the level of the unemployment rate of around 10%.
Let's suppose 10 years from now, when you say you might hang up your spurs at Netflix, what do you think you might want to do when you turn the ripe old age of 70?
I want to have my own interview show.
Well, I'm sure you could get that anytime you want one.
Is so meager that it insults the intelligence of the American people, does not solve the problem, and it is not, again, we know that we have to compromise, we know we have to negotiate in order to reach an agreement. We all want an agreement, make no mistake about that. But get serious, get real, Mitch McConnell.
Speaker Pelosi playing the blame game, all sides playing the blame game over the last month. That was an interview with David Weston on Bloomberg in the last 24 hours. From New York and London, good morning to you all. Here's the price action this Wednesday morning. Equity futures with a bounce after yesterday's losses. The losses that picked up steam on Friday with some positive follow-through, negative rather, if you're an equity bull, into Tuesday. Into Wednesday, equity futures up 19. We advanced 0.6%. Tom Keene pointing out a little bit earlier on, just don't see it reflected in the bond market. Yields not up. They are unchanged, 0.67%. And 24 hours away, we will hear from Christine Lagarde, the ECB. Eurodollar 117.63. Coming at about 0.1%, Tom.
John, what do you expect from the ECB meeting? We haven't mentioned it once.
I'll take the words from Stephen Gallo of BMO. Tricky one for the ECB president. For verbal intervention to work, Tom, on the currency, you have to believe there will be policy follow-through. And right now, not enough people do.
Yeah.
That's why the Euro bulls are still pretty comfortable with their Euro longs.
Well, we are comfortable talking to Kevin Cirilli, our chief Washington correspondent, now about 8 ways to go here. Kevin, I'm going to leave the stimulus aside and go to the polling as well. And what I find absolutely fascinating is the new political methods in a new pandemic election. Kissing babies doesn't get it done anymore. So how do you campaign?
Well, look, I mean, it's all virtual, I think, and once the diagnostic is and the post-mortem is written on this election, it's really going to be about the increase in ad revenue on both sides and money spent on streaming platforms. I mean, you can't turn on Hulu or any of the other platforms without running into Joe Biden or President Trump, and that really is a shift in terms of how the money is being spent. Of course, my colleague Jennifer Jacobs scooping over the holiday weekend that the president is willing to spend $100 million of his own cash in order on the re-election.
Well,
and there's an NBC News Marist poll out today that has President Trump trailing Joe Biden in the battleground state of Pennsylvania by 9 percentage points, but it's neck and neck in Florida.
So you go to Minnesota, which is sort of a pure TV market, a pure digital market. You know, there's not like Kenosha stuck between Chicago and Milwaukee. You go to Minnesota, how do you spend the money over the next X number of weeks? TV?
Well,
Are you going to tell me they're going to do it off Facebook?
No, for President Trump, he's going to go there. I mean, and the Trump campaign has decidedly been going and campaigning more. Yesterday, they were in 2 states, and he's having smaller sized events, but still, flying in and drumming up the local media. I think with Minnesota, what's really interesting is that this is a state that Trump lost to Hillary Clinton, but the Republicans that I talked to, the sources I talked to on the president's re-election campaign, feel that that's a state that they could crack in. And on election night, and well, the weeks after, if you follow the mail-in voting issue, I'm really going to be watching Minnesota, because should Republicans perform strongly in Minnesota, that would suggest that they would perform strongly elsewhere. Ditto for Florida. If Democrats pick up Florida, that would suggest that it's going to be a strong night or weeks, depending on the mail-in voting, for Joe Biden.
Kevin, the blame game, full swing down in Washington, D.C., and I'm just wondering how this is playing out in the polls right now for Republicans and Democrats. Who's winning, so to speak? I certainly don't think anyone's winning right now, but what's your view? How's this playing out in the numbers?
You know, it's really interesting because the fiscal debate and the fiscal stimulus debate has not really factored into the virtual campaign trail yet. But it's definitely something that business leaders of all sizes are closely monitoring, as are investors. But in terms of voting as an issue, it really is reopening the economy and the pandemic that are really driving the movement in the polls. But I would argue that from a longer-term strategy, 3 months, 6 months out, that more spending from the government is likely on the horizon. Whether it's before November 3rd or not, we don't know. But we're still talking about massive amounts of money in stimulus, whether it's the $500 to $700 billion that Leader McConnell proposed yesterday, or the $2.2 trillion that Speaker Pelosi and Democrats would like to see. Eventually, they're going to get to something. We just don't know when.
Kevin, let's talk about that skinny bill. Is there any money in that allocated towards states and local governments?
a fraction of what the Democrats want. But to your point, Lisa, I mean, this is really could be one of the driving issues as it relates to potential furloughs or worse layoffs by the end of the year. You look at firefighters, which of course are having to fight record blazes out in California, more than 2 million acres already burning. You look at the police department in New York City. You look at all of these local and government officials who are employed, teachers across the country. This really could be a significant risk for them from an employment side. And whether or not that issue comes up in the debates or whether it comes up in a lame duck, that's what's the biggest unknown variable. But again, from a broader step back, 3 to 6 months out, likely more fiscal stimulus coming out of Washington.
Kevin, what kind of Republican support is there, or is there any bipartisan support for more funding for states and local governments?
Well, Larry said this to Jonathan Ferro the other day. I mean, look, they view these positive economic indicators as a sign that this is moving in the right direction. You look at an 8.4% unemployment number, and that's something that the Republicans are saying, you know, maybe more stimulus isn't needed immediately. Now, in contrast to that, Democrats, nominee Biden, vice presidential nominee Kamala Harris are saying that this recovery is not working equally for all Americans. So it's this fascinating debate about the data that has really shaped the contours of the conversation coming out of Washington.
Hey, Kevin. Great work and fantastic reporting on China in the last 24 hours as well. Kevin, thank you. Kevin Cerulli, Bloomberg Chief, Washington correspondent. Tom, you know what the debate's going to be in the next couple of months if we don't get the fiscal package? The pressure to reopen and push to open further some of these economies is going to build. And something I've noticed in the last several weeks, there was a social stigma attached to big business coming out and pushing that message several months ago. Not anymore. Michael O'Leary of Ryanair was on Bloomberg TV this morning in Europe, absolutely obliterating governments, including this one here in the United Kingdom, for not having proper testing regimes, for not allowing the planes to get into the skies, and for not doing something about business travel.
The math is there, and this is from Johns Hopkins University, among others, on the death rates. There are some huge successes out there. I would argue never have we seen this in virology. I mean, the United Kingdom, a success. New York City, a success. Why can't we open up then? That's the debate.
Well, let's be clear about New York, Tom. I think we've got to talk about that. If you cannot eat indoors this winter, and if the government is going to turn around and say we won't pay people to stay at home anymore, then you've got to reopen the economy. You've got to do something with testing. There's going to be a big push and pull there.
No, well, we're there right now. I would say that they're there, John. You know, I
agree.
The leaves are changing, John, in New York City right now, where it's becoming more autumnal. The debate ensues.
Get long outdoor heaters. It's not even funny. Equity futures this morning pushing higher ahead of the opening bell after the rout of the last couple of days. S&P 500 futures up 21. We advanced 0.6% from London and New York. Live, heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
This is...
Okay, ladies and gentlemen, new order please for euro. I'm placing an order to sell short at 117.645. Order placed to sell short at 117.645.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
When everything around us, including the way we work and live, has been interrupted, uninterrupted service is peace of mind. Kimmy from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Live on Bloomberg TV and radio, this is Bloomberg Surveillance for our audience worldwide. Here's the price action this Wednesday morning. The bulls doing a little bit of a cleanup after the mess in the last 24 hours in this equity market. If you look back 3 days on the NASDAQ, a 3-day loss of almost 11%. Futures positive today. S&P 500 futures up 23. We advanced 0.7%. We briefly mentioned the euro. Breach of 120 in the last week. Verbal intervention brought it back down. And some dollar strength broad-based helping things out, dragging euro dollar down to 117.60. In the bond market, treasuries pretty stable. 10-year yield unchanged. 0.67% is your yield on the 10-year this morning, Tom.
Lisa, I just figured it out after Tuscany. Farrell went to London because pound cratered.
Oh.
He's living large in London.
Well,
That's
actually,
what it is.
you know what I hear? I hear that he spends more on gifts if the pound craters because he's paid in dollars. So all of his family members
Farrow family
are living large.
The Farrow family are well aware that there are different tiers of Christmas presents, and cable at 120 gets you tier 1, cable at 130 or below gets you tier 2, and anything above 130 means a tier 3 present, which is a gift card of about $10. So south of 130 is good news for the Farrow household.
Very good. So much for Tiffany on Bond Street. Right now, the doctor is in. Dr. Sam Fazeli, with a doctorate in pharmacology, is truly expert on this pandemic and the hopes that we all have for a vaccine. He understands that the movement from phase 1, 2, 3 is fraught with risk, and the pro will speak to us now on this disappointment at AstraZeneca. Dr. Fazeli, good morning, and thank you so much for rejoining us this morning. What does AstraZeneca do this morning? What's the next step after you fail a phase 3 trial?
Morning, Tom, and thank you for a very, very kind words. But basically, what you've got to worry about is, and first, I wouldn't call it a fail. So obviously, we still have a trial that's put on hold. If the data shows that it's due to the vaccine, then it's up to the Data Safety Monitoring Board to decide whether it's a risk worth taking going forward. How you're going to convince people to sign up for taking doses then is a slightly different question. But it's also possible that it's something to do with either the vaccine itself in general, which would be bad news for other vaccine makers, or it could be to do with the way that the vaccine is delivered, i.e. that adenovirus. So we need the detail before we can make any judgments on that.
Sam, let's make some judgments, though, further down the line. Crystal ball, if you will. We know that 1, it's got to be effective. 2, it's got to be quickly and widely distributed. But 3, people are going to have to want to take this. Now, Sam, I just wonder if you can comment on the PR around this. There is so much pressure on these companies to push this through and push it through quickly. How widely received will this actually be once they do announce that we have one ready to go?
Yeah, so, John, with this noise or situation with the side effect, the sooner it's resolved, the better. The sooner it's dealt with, the better, if it's actually truly not related to the vaccine, which is entirely possible. But I think there's already some damage that's already taking place. It's likely that people who don't know much about how these things go may feel a little less inclined to sign up for the vaccine trials, or even if they are in them, to turn up for their first dose or indeed their second dose. So we have said that we think that some of the other trials are likely to see some slowdown in recruitment or treatment speed. So certainly, as I've said earlier, trying to get this data out before any specified date in November, I think is going to be unlikely.
Sam, are we focused on the wrong thing? I mean, John and Tom were talking about reopening the economy, the idea that because we've gotten the numbers down far enough, it should be a time to reopen the economy. And yet the only way to do that safely is if you have rapid tests that you can take and that can be scaled up so we can have millions, billions of them so people can just spit, find out they're negative, and go. Why aren't we more focused on that?
Absolutely right, Lisa. So at the end of the day, the vaccine is an ideal outcome. It would be a fantastic thing to have, hopefully, that is safe and sound. And then, because we all want to not have to wear masks, not have to socially distance. I don't want to spit in a tube every day. But given where we are today, we already have what is essentially a vaccine. I mean, I'm kind of taking some poetic license there. A mask reduces your exposure to the virus, and that reduces the impact of the virus on your infection. So you've already got that, and it's very easy to do, and everybody can do it.
Sam Fazeli, thank you so much. Greatly appreciate it with an update here. I'm sure we'll have many more of these discussions in the coming weeks. Right now, Gina Martin-Adams on this market with futures up 20, up much more earlier, but still a nice lift, a nice move to stability after what we saw yesterday. Gina Martin-Adams, what will you write about this morning?
Well, this morning we wrote a lot about index valuations. We think that the correction that we've had over the last couple of weeks has really just been about deflating a mini tech bubble, not about a broad S&P 500 sell-off that was necessary because of valuations. And I think that this nuance is pretty important to assessing where the market goes from here, because frankly, the party stopped and the S&P 500 valuations stopped rising when the Fed balance sheet stopped rising in June. But nobody told the tech sector. And we're seeing a little bit of deflation in the valuations of tech. We probably need to continue to see that to close the gap with the rest of the market, which is going to create a pretty choppy market over the course of the next month or so. But frankly, the rest of the S&P 500 is not expensive. It's actually cheap by historical standards. We've got 90% of the index trading with an earnings yield above yield on mid-grade corporate credit. We've got more than half of the index trading at below average price-to-book multiples. So we started to dig into valuations and really assess the outlook.
Gina, you do a tremendous job of bringing the technicals into the conversation as well. Can you speak to that a little bit, just how supportive they are at the moment?
Yeah, well, there's nothing really special about where we bottomed last night. So I would say that the bulk of the evidence would suggest that this will be a little mini bounce within a corrective process for the S&P 500 over the short term. You typically see the index form a bottom when 14-day RSI or short-term momentum on the index reaches somewhere between 35 and 40. As of yesterday, we were still above 40, so we're not oversold by any stretch of the imagination. 2 weeks ago, we were extremely overbought. In particular, sectors like technology, communications, consumer discretionary were trading at overbought levels we hadn't seen in years. So we're certainly due for a correction in the big cap tech names and the mega caps in the S&P 500. We've gone through a significant amount of that correction, but it's tough to say that we're forming a bottom right here because we really haven't gotten oversold just yet.
Well, Gina, this is the problem for a lot of people that they confront this morning and over the next couple of days. Is this just a correction, something broad-based, or the beginnings of that rotation? Again, Gina, what would you pick this morning?
Yeah, our view has been that we're in the midst of a rotation. I think if you actually do the work and decompose the equity market into factors, you find that the long-short value factors started to outperform all the way back in August. Over the last week, we've seen material stocks actually up over the 5 days, industrial stocks falling less than half the market pace. This has been a rotation in a significant form toward more value sorts of sectors. We need to see that continue to take momentum. Last week, we published our sector scorecard early in the week, and for the first time since 2018, the tech sector fell out of the top 3 rankings for the S&P. So the tech sector did fall into sort of the middle of the road. more value-oriented sectors like materials and industrial started to work their way higher on the scorecard, along with consumer discretionary and the healthcare sector. So I do think you'll have a mix of leadership or a shift in leadership that occurs not only has it occurred over the last month, but it'll continue to occur over the next several months, anticipating some degree of earnings recovery, some degree of economic recovery into 2021 with new leadership.
Well, Gina, putting the narrative aside, because it's been a very hard time to put a narrative to any of the market actions that we've been seeing, we start to look at the who behind the market actions. We've been talking a lot about SoftBank and some of the big options trading that they were doing. Who is left holding the bag at the top of some of this froth in the tech sector?
Lisa, are you looking at me?
I'm looking at you, yeah. I mean, I know you were unloading that all cash, that room full of cash.
Yeah.
Afterthoughts,
yeah, I think if you think about the S&P 500, you have seen something of a mini bubble, if you will, develop in the mega cap tech stocks. And it does appear that a lot of that mini bubble was created by the combination of institutional investors really chasing returns, sort of getting dragged into the market after the second quarter gains really surprised everyone. We did see institutional investor flows into some of the mega cap names in July and August, but also a continuation of the speculation among the retail investor universe. I mean, it's hard to ignore the fact that retail has been responsible for roughly 20% of equity market flows this year, and historically they average about 15%. So you are seeing some degree of speculation. You're certainly seeing, the highly levered triple Qs experience a tremendous amount of flows in either direction. So it is very clear that there is a speculative component of this, and that's somewhat retail driven. But that's not the only story. We did see institutional start to get pulled into some of these names as they chased performance to some degree. We're now seeing that froth removed from the market, and I would say the more we see that froth.
Okay, ladies and gentlemen, as you can see, the position opened, short position for euro, 117.645.
Years from now, we're still going to see multiples at relatively high levels. We're just going through a small adjustment process to normalize multiples that had gotten somewhat inflated relative to the broad market with respect to mega caps right now. And we've got to go through that process. We will see multiples likely stabilize, and they'll stabilize higher than anybody believes is realistic. And that's because you still have a tremendous amount of liquidity provision at the Fed, and you just can't ignore that longer term.
Hey, Gina. Always enjoy catching up with you. Love catching up with you. Gina Martin-Adams there, Bloomberg Intelligence Chief Equity Strategist. Loving the idea, Lisa, that there is a room full of cash at Tom's house. I can reveal for our listeners and our audience worldwide, there's basically a guitar in every room, and in some rooms there's two, and I still haven't had an explanation as to why. Tom, why do you have so many guitars?
Oh, they get lonely. So,
they get lonely?
They get lonely, yeah. So
they're just on the floor, hanging out.
They're not on the floor, but they're just hanging out. Like, that's what you do.
He's hoping somebody will throw a couple of dollars into the room to fill it up with cash so he can triple leverage it up.
Tom.
That would be true. Yes, that would be true.
I've got a video of Tom singing Happy Birthday on a guitar.
Oh, really?
That I might distribute one day. I've got a lot of leverage on you, to be honest with you.
Okay, it sounds like we need a musical.
That's blackmail right now.
I don't know.
Live on television.
He knows I've got a lot of material. Let's get to the price action this morning, shall we? That is our song. That is our anthem. I put that out on Twitter a little bit earlier. I don't know why it's our song. Why is Toto Africa our song? I will never know. Equity futures positive this morning from New York and London. I have no idea what's going on sometimes on this program, and maybe that's my fault more than his. Lisa, just sit out of it. This is Bloomberg.
With First Word News, I'm Rishka Gupta. Senate Majority Leader Mitch McConnell says the new Republican stimulus plan focuses on restoring supplemental jobless benefits and extending help for small business. The Senate votes on the measure tomorrow. It will cost as much as $700 billion. That's about a third of what House Democrats want to spend. Joe Biden opens a new front on economic issues today. The Democratic presidential candidate heads to the battleground state of Michigan. There, Biden will unveil a new policy aimed at fighting offshoring. That's the practice of U.S. companies basing some operations in low-tax countries. Polls show that voters are starting to trust Biden's approach to reversing job losses. And blackouts tied to wildfires are now spreading beyond California. Oregon's Portland General Electric turned off power for about 5,000 customers near Mount Hood. Dry winds were threatening to take down power lines and start fires. It's said to be the first time such a public safety shutoff has happened outside California. President Trump plans to announce further reductions to the number of U.S. troops in Iraq today. That's according to an administration official. About 5,200 American troops are still in Iraq. It's not clear how many will leave or when that would take place. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
I do double down on helping other Black founders, whether it's fundraising, hiring, growth, product, whatever it is that they need.
That over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
The investment bank merger is something we have been discussing actually for months. This is not a cost exercise. There will be some cost benefits, but it's really about having one underwriting business, to have one investment bank globally, one equities business.
Just a handful of really good companies, but the valuations are absurd. And what's happening is analysts are taking out their expectations out many, many years. So, okay, you got a great company, low debt on the balance sheet, but they're artificially inflated. They just need to be revalued lower.
It's not just about a story, it's about the price of the story. Chad Morganlander there of Washington Crossing Advisors. The price action this Wednesday morning shaping up as follows. Cross-asset worldwide, beginning with futures, stateside. Equity.
Stop on profit placed at 117.605. I'm placing stop on profit at 117.605. Okay.
No, John, Turkish lira from a 7.40 buttressed right up to 7.50 right now. It has been an ugly, ugly week for Mr. Erdogan battling that weak Turkish lira. Right now in oil, we've really ignored this, and it's been my fault. Amrita Sen joins us with Energy Aspects, terrific microeconomic analysis of what's going on in oil, but also the broader picture as well. How do you respond, Amrita, to the certitude of the pundits that this is just a bet on weaker global demand, a weaker global economy? Do you buy it?
Well, Tom, I'd say that we really never were talking about a strong global economy, right? I think if anything, the price of oil is finally catching up with fundamentals. We talked about it not that long ago, the contango in the market. So the futures price was telling us that, prices in the future will be higher. And that was already showing the contango had widened. It was showing the physical market was oversupplied when OPEC had started to ease their cuts and U.S. production was coming back a little bit. But the price didn't move, and that was to do with the fact that, Feds kept the interest rates so low, so there's so much money around, and the dollar was extremely weak. Finally, those factors changed, and that's essentially what dragged prices lower. This was long overdue, and I think what this should help is accelerate some of those inventory drawdowns, which we're already seeing, but it should get bigger. And that's the only way we will rebalance this market.
Well, okay, I'm going to draw the ire of some of my co-hosts, perhaps, but trying to come up with a narrative to understand whether the moves in the equity market have been consistent with what we're seeing in oil. Oil seemed to be moving somewhat independently of the stock sell-off that we saw, the NASDAQ sell-off in particular, over the past 3 sessions, particularly having to do with OPEC cutting prices and people not increasing their orders all that much. Do you find the price
Position closed at 117.605. We have profit for £100.
The problematic thing with oil, of course, right now, the headwinds really, is that demand is recovering, like you say, I think, and you can see that in the equity market, but also whether it be home sales, data, and just generally even, broader macro data in China, other parts of the world, recovering for sure. But it's transportation that's the weakness, right? And unless and until there's a vaccine, it is going to be hard to get people moving in the same way. Yes, traffic data is picking up, but, flying jet fuel demand remains at record lows still. And that is the issue over here. And that's why I think it is correct for oil to diverge from equities broadly. But once you have run down the inventories and once you do get the demand recovery, which, by the way, is a good year, if not 2 away, then things will probably correlate a lot better.
This is crucial, this idea that perhaps the economy can recover without people flying around and traveling around to the degree that they did in the past. How low could oil prices go, in your view?
I don't think that when we're talking about the recovery in demand, we're not saying that the recovery is going to take us back to pre-COVID levels, right? We should be very clear on that. We are recovering, but it's just that unless and until that last bit, which is going to be very oil-intensive, recovers, we're really not going to be able to go back to 2019 levels. I don't think there's much more than a $2, left in the corrections. It's been very, very violent. I think at around $35, we should find a floor. I think U.S. production, the recovery we were seeing, very gradual. That's going to go back down again. And I think as a result of that, you will probably start to see more pressure generally on those supplies, which again helps in the rebalancing.
Is this pullback advantageous for Saudi Arabia to provide new discipline to OPEC Plus?
I think it's not going to do them any harm, especially given they've been trying to get compliance up And to be honest, Iraq and Nigerian compliance has been picking up. It's been more of the other GCC countries, some of them, that their compliance has been slipping off late. But yes, I think that's very much the focus. And while Saudi Arabia would, of course, like prices to be around $40, they all have very high budgetary requirements. I think this does play to their advantage in the short term.
What do you see next then? To Lisa's point, I mean, on the date calendar here, what does oil do next?
I think for now it has to consolidate, and unfortunately it's going to be pretty boring because unless and until the billion barrels we've built gets kind of absorbed, it's really not going to get exciting, and prices can't really move higher. I think the next big thing has to really come from the winter demand side. So, that's what I think a lot of people are focusing on, because the macro picture is gradually improving, right? But that's very gradual. There are risks around the second wave and second lockdowns around the world. So it's really going to be about the winter demand next.
Amrita, love catching up with you. Great to catch up with you this morning. Amrita Sen of Energy Aspects, thank you. Tom, maybe the purest play on just pure supply demand fundamentals, crude. Everything else heavily distorted by central banks and the like.
Absolutely.
And we saw that play out aggressively in the last several months.
It's really comfortable to look at oil. Is precisely, John, as you say, it's removed from fiscal and monetary debate. Removed here is the bond market, a little bit of risk on, John. The idea of the 30-year bond up a basis point. I'm struggling here. The 10-year yield up a basis point as well. Not much, but nevertheless, an improving tape from where we were 2 hours ago.
Messy road to nowhere in the bond market. Been all over the place, Lisa, in the last couple of weeks, and right back to where we started, really. Still pretty range-bound.
Hard to understand the dynamic right now, given the record supply, the record issuance that we're seeing from the U.S. Treasury Department at the same time that people are expecting slower growth. I was really interested in what Jeff Gundlach had to say last night. He was talking about inflation expectations and betting against the TIPS market, the inflation-protected bond market, basically saying that people were too optimistic, at least in the prices expressed there, about inflation going forward, that pandemics are deflationary. Very strange dynamic to get your hands around right now. John.
A conversation we can continue, Lisa, with Omar Aguilar, Schwab Chief Investment Officer. He'll be joining us very shortly on this program. The price action shaping up as follows. Stateside going into the opening bell, about 95 minutes away. Equity futures bouncing back after yesterday's losses. Futures positive on the S&P 500, up 0.8%. Nicely positive on the Nasdaq too. As Tom points out, a lift on Treasury yields now up about a basis point on a 10-year. Yield is 0.69%. And in foreign exchange, I think tomorrow is going to be fascinating for ECB President Christine Lagarde. 117.65. Words aren't enough. If you don't like a strong euro, what are you going to do about it? And when are you going to do something about it? Maybe they like the fact it's nowhere near 120 right now. That's tomorrow's story. 117.64 on euro dollar. From London and New York, this is Bloomberg Surveillance.
give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
The longer term is not looking good right now in terms of the support for consumption.
This economy is dynamic, but not dynamic enough given the shock that it has received.
This is a different correction than certainly we've seen in the past.
Any sort of sharp move higher in yields is when I think I see the Fed coming in, putting a lid on how high yields can go.
So I think we're all focused on that September Fed meeting.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrell, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. A spirited Wednesday here. Bloomberg Surveillance. Good morning on radio across the nation in Boston, New York, Washington. Good early morning, San Francisco. Good morning on Bloomberg Television as well. Interesting markets as well. We'll talk about the market here in a moment, whether you need to climb back on board. Yields. John Farrell, let's get right to the yields right now. Yields a little bit higher here. That's proven to be a lower prices, stronger yield just in the last hour.
Yields up about a basis point on a 10-year, Tom, but let's be clear. Yields have been all over the place, but haven't really gone anywhere in the last week. We've settled in and around 70 basis points on a US 10-year, and that's about where we are this morning.
Yeah, no question about it. Futures up 28, Dow futures up 167. John, we got to touch on Tiffany. I know you wander over to 25 Old Bond Street now that you're back in London, and you need that Tiffany black tea with those two bone china mugs for 200 pounds large. I mean, that's what Tiffany does in London. That's what they do here, but they're not going to do it, John, with LVMH.
Yeah, I'll take a pass on that, Tom. I'll be spending less time there, that's for sure. Tiffany right now, negative in the pre-market, down 9% in early trading. 135 was the deal price, Tom. LVMH walking away. Right now we trade at about 111 in early trading. Tom, the reason they're giving and the reason people are suggesting this morning is around tariffs on French goods.
Yeah.
Now, it's not for me to say whether that is a reason or an excuse, but let me tell you, this has been on the radar all summer as to whether LVMH will walk away given what happened over the last 12 months. Remember, this deal was closed 12 months ago, Tom. In fact, almost 12 months ago. And then we had the pandemic. And then everyone thought they'd reassess the deal and walk away. And this morning, they've finally done it.
You know, some litigation out front here. Lisa Abramowitz, some of this goes to everything gets recalibrated. Give us an update. You nailed that 3-year auction yesterday. You know, I think they're boring. This one was not. It didn't go all that well, did it?
They're never that boring. Let's clarify the fact that perhaps it didn't go all that well if you look at some of the internal technicals. Still sold at an all-time record low yield of 0.17%.
Wow.
But to this larger point, though, I do want to just touch on Tiffany, not because I enjoy shopping there, I do shop there, but this idea that LVMH is using the tariffs as an excuse. Is 2020 going to be the year of conscious uncoupling? The idea of the increase in tensions that we're seeing geopolitically at a time when there are these increasing tariffs, and the French government is said to have gotten involved to some degree to give LVMH a reason to walk away. At what point are these cross-continental deals going to fall apart in a protracted way, Tom, could shape the way that we look at markets in the years to come?
And John, this is really
Gwyneth Paltrow? Conscious uncoupling. Was that Gwyneth Paltrow?
Yeah, that was good job. Good job.
Gwyneth who?
Thank you. No, thanks. I mean, I'm best friends with Tommy. Informs me all the time about the celeb love stories.
Just wanted to bring a little Gwyneth Paltrow to the morning. Tom, carry on.
Okay.
Is she sell side or buy side?
I think
she's on the buy
she's
side.
She's definitely on the sell side, though, with Coop. And moving right along, though, it does raise a question about how you operate in an era where you do have these growing tensions on all sides, particularly between the U.S. and China, Tom.
Let's stagger to our guest as we can. Omar Aguilar, Schwab Chief Investment Officer.
Omar's not there anymore. Let me tell you.
Omar hung up and goes, you know, I can't come on after Gwyneth Paltrow. Good morning on Bloomberg Radio and Bloomberg Television. Thrilled you're with us on our simulcast. And Mr. Aguilar will give us some brilliance right now. What is the character of this pullback? You have the advantage of Kathy and Liz Ann to give you perspective as well. What is the nature of the pullback we've seen, Omar?
Well, good morning, Tom. Definitely is that out of my range of understanding a lot of the discussion regarding celebrities, but I can tell you though that a big part of what the market is going through now is something that, in a way, shouldn't be coming as a surprise as we come out of the summer and such an amazing run in the market. We clearly speculated what could be the fall look like, and if you actually see all the sources of uncertainty we had and the gap between the market and the economy getting bigger and bigger, that all of a sudden created that environment for a potential volatility. And what we are observing right here, you put it into the context of the size of the rally that we have seen since April, we're just seeing volatility. The size of the correction, even though in the NASDAQ has significant, is still very small relative to the size of the bull market we saw earlier in the year.
Omar, a really serious question, and I don't want you to speak for the executives of Schwab and Mr. Schwab as well. He can do that for himself. Schwab and others in retail electronic brokerage have been piñatas about the sizable retail trading we're seeing. Do you buy that idea that there's something ill about all that retail trading?
Well, our job at Schwab is always to guide retail investors to find their best way to trade, and in many cases to find, the opportunities they find in the market so that they can use their capital in the wise way. Of course, there's a lot of players in the market. There's a lot of activity in the market, and the size of the retail trading, especially the high frequency retail trading, has had an impact in the market, no question about it. Now, I think a big part of the discussion of what we do at investment management part of Schwab, it also involves, trying to guide them into the behavioral aspects of the market. If you actually see a lot of the retail activity, it usually tends to be very short-term in nature, and in many cases tends to be fairly related to behavioral economics. So we do a lot of research, and we provide a lot of advice to our retail clients to try to guide them to understand what is really the motivation behind a lot of the trading. Is it really more for a short-term trade? Yeah. Is it really more consistent with their investment objectives?
Well, Omar, you mentioned two things there. One on size, the volume clearly increased over the last 6 months on the retail side. The other on the character of the trading. Can you talk a little bit more about that, whether you've seen a shift to more short-term than perhaps it was 12 months ago, whether you've seen a shift from just the underlying stock to more options activity, which is a big discussion in the last week or so. Can you give us some color, some clarity there, Omar?
Well, I think the market environment has actually put, clients and in general, investors in like two camps, and you can actually very clearly see through the activity that we see in the market. On one hand, we have what is called in behavioral finance the overconfident crowd, that is a cognitive bias that basically feels that clearly short-term trading, it is the place to go, mostly because central banks provide that extra liquidity and backstop for the market to continue to follow that trade. You can actually see that more in options. You can see that more in just the momentum trade. You can actually see, and you can obviously think about all the different participants that are trading on and off regarding those short-term, components. On the other hand, and we see that more and more often, we actually see more of the other side of the trade, which is some of those, investors that tend to be more risk averse, where loss aversion, which is more of an emotional bias in behavioral economics, that tend to actually drive more and trying to be more safe and try to put more cash on the sidelines and looking for protection. So when you think about options, it's both ways. It basically allows for you to put money to work in the market to try to put, your views, but also to try to seek protection. So we actually see, basically a bifurcation in terms of the way that activity goes. One is more short-term in nature. The other one tends to be more long-term in nature.
So does this all balance itself out and keep the rotation into cyclicals intact despite the tech sell-off? Or are we going to basically be set back, and is tech going to regain the helm and everything else going to kind of limp along for a while?
Well, I've always, described this in just the theory of economics that basically say when you look at history of recessions, normally the market takes off before the recession is finally completed. But one thing that has been common in all the prior recessions is that the source of the recession gets resolved before you start seeing the rotation from growth to value. Even though the market can continue to go up, you actually see the rotation, into value from growth, and that's very typical of most of the recessions. What is unique about this one is that this looks more as a recession that comes from a natural disaster more than an economic, driven, recession. And the reality, though, is that the majority of the natural disaster recessions, they are actually solved because the natural disaster is gone. In this particular one, we have not resolved the source of the recession. We're still trying to figure it out, and therefore it's going to be very hard, Lisa, to basically think about a serious rotation until we actually have or get to the source of that, solution for the recession source.
One from me. Clearly there's many people that still haven't gone back to the office. Have you got any basic assumptions on what happens to volume with guys like yourself right now once people start going back to the office again?
Well, it's
This morning, equity futures with a lift, Tom. I'm 0.9%. We approached 32 points higher on the S&P 500. From London and New York, alongside Lisa Abramus and Tom Keene, I'm Jonathan Ferro. This is Bloomberg Surveillance.
With the first word news, I'm Rishika Gupta. Senate Republican leader Mitch McConnell is setting up a vote tomorrow on his party's latest virus relief bill. It's a so-called skinny proposal designed to break the logjam with Democrats in the House. The Republican bill will cost up to $700 billion. That's a far cry from Democrats' $2.2 trillion relief package. Once again, U.S. infectious diseases chief Anthony Fauci is countering something President Trump has said. This time, Fauci says it's unlikely that a coronavirus vaccine will be available by Election Day. President Trump has hinted that a vaccine could be ready by then. That has skeptics concerned that politics will influence regulatory decisions on immunizations. And in the UK, Prime Minister Boris Johnson will ban all social gatherings of more than 6 people. A surge in coronavirus cases to 3,000 per day is prompting Johnson to act. There will be exceptions for organised sports, plus for people getting together for work, weddings and funerals. And bond market guru Jeffrey Gundlach says high-yield debt default rates may almost double. The manager of the double-line total return bond fund says the Fed's policy actions are distorting asset values. Gundlach's views reflect broad skepticism about the market's connection to economic realities. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
we are above forecasts. 1,800,000 jobs is the total non-farm payrolls, with a 17,000 additional jobs added in terms of net revision.
You still got 1.8 million with a big decline, almost a full percentage point drop in the unemployment rate, which will move to single digits easily in the summer and fall.
Leading up to this data, there was a lot of reason to suggest that the pace of increase had slowed. And in fact, what we see in this data is, of course, it has slowed. But the good news is that it is continuing. And it is continuing despite some slowdowns that we're seeing around the country as a result of an increase in cases.
People tend to focus on the growth rate. The big issue is the depressed level of spending and income in the economy, which is reflected in the level of the unemployment rate of around 10%.
Some things you see coming, some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
We know it's a pandemic, and we want to be very responsible for pricing. We plan to underprice this vaccine for its value, especially in the pandemic phase.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Relative to the rally we've seen, the pullback isn't that large, but people get used to coming in every day and seeing NASDAQ up 5 weeks in a row, and this stuff becomes, much more emotionally painful.
Stuart Kaiser at UBS, the head of equity derivatives research on this program in the last 24 hours. Fascinating conversation. Those conversations will continue over the next hour. We'll catch up with Julian Emmanuel of BTIG and Mike Wilson of Morgan Stanley on Bloomberg TV a little bit later. Look at the price action this morning, right here, right now, right in front of us. Equity futures drifting higher at 1% now on the S&P 500. Tom, a very subtle mild lift on Treasury yields, up about a basis point on a 10-year to 0.69%. One thing that just hasn't disrupted this market, Tom, and it's been fascinating over the last several months, a clear breakdown in relations once again on several fronts between China and the United States, and no clear read across in financial markets. I've got to say, Tom, no real disruption right now, certainly not in the same way there was in 2018, 2019.
There's no question about that. And of course, if we've heard, including conversations this morning on Bloomberg Surveillance, the idea that it is decidedly bipartisan in the United States, where you wonder the day after the election, what will that be like? We talk about the special relationship with the United Kingdom and the United States. Well, maybe there's a special relationship with the U.S. and China. Jacob Parakilis is at the London School of Economics and really specializes in U.S. political analysis. We're thrilled he could join us this morning. Jacob, given a bipartisan tone in Congress, what will be that special relationship post-election?
Well, I think, it's certainly right. There's a bipartisan perspective, or a largely bipartisan perspective on China that maybe wasn't there 6 or 8 or 10 years ago. We've seen a number of issues that have really driven both the sort of more conservative and more progressive lines in U.S. foreign policy. Those include the situation with Uyghurs, what we've seen happen in Hong Kong, the new security law there, and the increasing sort of evidence of industrial espionage through Huawei and other means. So I think the broad strokes of U.S. foreign policy, an attempt to compete on China and prevent China from overtaking the U.S. in key military, strategic, and economic dimensions, is largely settled. I do think there'd be a fairly different approach, particularly towards U.S. allies who might reinforce American policy towards China if Biden were to win in November versus Trump. I think Biden would have a more conciliatory attitude, whereas Trump is to try to sort of browbeat allies, sometimes against American strategic sort of preferences, broadly writ, into, for example, giving more money for basing rights from Japan and South Korea.
Well, we saw Clinton and Trump both go after PPT, I mean, the idea of a Pacific multilateral agreement. Is there any room for President Biden to go to a multilateral approach?
Yeah, I think despite the tenor of the 2016 elections, I think the polling suggests that there is a pretty broad American openness to reviving something like TPP. Whether you could get it through, if Biden, let's assume for the sake of argument that Biden wins and has a Democratic Senate, he would still need to bring somewhere between 17 and 15 Republican senators on board in order to ratify something like TPP. He could try to re-enter it as a less effective executive agreement, but that, of course, would open up the possibility that, as happened with the JCPOA and the Trump administration, the next Republican administration could simply walk away from it. And I think Biden will want to do, if he wins, is to reassure allies that the U.S. has moved out of this kind of ratcheting back and forth between extreme Democratic and Republican positions, and that is moving more towards the consensus position on arguably the biggest foreign policy issue of the day.
Well, Jacob, it all comes back to one question. What's the best way of trying to influence the behavior of the Chinese Communist Party? Have we learned any lessons in the last 20 years? What is the best way?
I don't know that there is a best way. I mean, there have been things that have been modestly effective at certain times, but I mean, the fundamental problem for the U.S. is that China is more powerful than it was 20 years ago, and it doesn't have a network of alliances the way the U.S. does. It increasingly has countries that are willing to take its side in disputes, if not full alliances. Even that is a greater degree than it was, 15, 20 years ago. It still doesn't have the kind of relationships that the U.S. does. Now, those relationships have been severely strained by the last few years, by years before that, to be fair. But, that is still the U.S.'s greatest power in the relationship, and I think reinforcing that is probably the best strategy the U.S. can hope for.
Jacob, great to catch up. Appreciate your time today. Jacob Parakielis there, London School of Economics and Political Science Associate. Tom Keene, arguably, and I say arguably because it is one single argument, but arguably the biggest obstacle to influencing the behavior of the Chinese Communist Party right now, it's not just the administration's approach, it's the coziness of the C-suite in America with the Chinese Communist Party. And that's why I think the Walt Disney Company, that example in the last couple of days, is absolutely fascinating. On the one hand, you have an administration trying to clamp down on authorities in a very, very concerning story in Xinjiang, China, and the alleged human rights abuses taking place of Uyghur Muslims, Tom. And at the same time, you have a U.S. company, a symbol of corporate America in the Walt Disney Company, thanking the authorities for allowing them to film there to make Mulan, Tom. How on earth do you make changes and influence the behavior of the Chinese Communist Party when these huge symbols of corporate America, the Walt Disney Company, Apple, the Walt Disney Company, Apple, all of those names, Tom, they want to be close, they want to be present in that country.
It's a buttressing of politics with capitalism, and the political capitalism of the moment can be everything, including the various Disneylands across the Pacific Rim. I mean, the problem's not going to go away, John, that's for certain, although it is overt to see it in the credits, as we saw here in Milan over the last couple days. But I would suggest, John, it's not just about the visibility of Disney in Milan, it's about those that are invisible, and there's a huge, huge relationship going on. There's no question about that.
Yeah. I would go further, Lisa. It's a collision between communist central planning in China and free market capitalism in the United States. In the United States, there is not a tradition of telling their companies what they can and cannot do. And I think that tradition is quickly changing right before our eyes.
And meanwhile, you've got U.S. companies that if they see a business opportunity, they are going to stay in China. There was recently a survey done by the American Chamber of Commerce of manufacturers in Shanghai, and it showed that only 4% of them were thinking of shifting any production out of that region back to the U.S., despite President Trump. Really, this comes down to you can ask for a lot of things, but how do you get it? How do you incentivize businesses? Right now, very hard to see that, John.
Tension not going away, Lisa, is it? Equity futures this morning up 30 on the S&P 500. We advance around about 0.9%. The equity market doing better than yesterday, that's for sure. In the FX market, the euro just slightly weaker. Euro dollar 117.69. And in your bond market, just a bit of a snoozer all day. 0.68, call it 0.69% on a US 10-year. From New York and London on Bloomberg Radio, on Bloomberg TV. This is Bloomberg Surveillance.
Me gustaría decirle a los empleadores que fueran más humanitarios con sus trabajadores, que les hagan valer sus derechos. Y estábamos viviendo en dos casas, en unas 50 personas y en la otra otras 50. En cada casa había 5 habitaciones. En cada habitación había de 3 a 4 camas abarrotadas. Vivíamos de 6 a 7 personas. Un baño para cada habitación y una cocina para todas. Una vez que nos atendieron en el hospital, al salir nos avisó una compañera que ya nos habían reportado a migración. Gracias a Dios ahorita de salud yo estoy muy bien, pero en lo moral no estoy muy bien, porque a causa de esta enfermedad yo perdí todo, perdí mi trabajo. Yo creo que mi caso resulta un gran problema de cómo las personas migrantes estamos en riesgo de explotación por parte de los empleadores.
Let's suppose 10 years from now, when you say you might hang up your spurs at Netflix, what do you think you might want to do when you turn the ripe old age of 70?
I want to have my own interview show.
Well, I'm sure you could get that anytime you want one.
The rapidity with which we are moving relates more to technological advances in how you can make a vaccine even before you start testing it. That makes me confident that we are going to do everything we can to determine safety.
From New York and London, this is Bloomberg Surveillance Live on Bloomberg TV and radio. Here's the price action this Wednesday morning. Shaping up nicely for the equity bulls after a rough couple of sessions. Make it 3 on the Nasdaq, down around about 11% over the last 3 days on that benchmark. The S&P 500 doing nicely, up 0.9%. The euro settling in at around 117.75 ahead of the ECB tomorrow. Crude bouncing back too. It's that kind of day. Crude up by 2% after yesterday's rout. $37 and around about 46 cents is where we trade on WTI. Tom Keene, the only thing you need to know is this coming weekend, Swansea, Preston, North End, Deepdale Stadium. At some point, that's where we're going to get you.
Road trip.
At some point this year, road trip. I think you could do a nice little quarantine for 14 days in Blackpool or something. That would suit you. I'll take you up there. And then we'll go watch a game together with John Riding.
We do this and we welcome all of you on Bloomberg Television and Bloomberg Radio because, you know, let's stop here right now, John, because I think it is important. And we've got some generous time. Rip up the script because we've got John Riding with us as well. John Farrow, nobody's done sports in this pandemic as well as English soccer. Does that surprise you, John Farrow?
I was surprised that we didn't have one team at least in the Premiership get something come down with COVID and games started getting messed up. And Tom, it just didn't happen. In fact, maybe that was luck. Maybe that was just by design. I don't know. But I wish them the best of the luck for the season as it begins. And we're lucky we got John Riding with us because he is close to Preston North End, Tom. And there is a big push this year already, maybe even the next several months, to get the fans back into the stadium.
Well, get them back in. And John Riding, good morning to you with Breen Capital. We'll talk about economics, the importance of the JOLT survey here. But John, just simply on confidence of society in getting us back to normal, can you envision sports events like your Preston North End peopled here before the end of the year?
Well, they are planning a restart, and what they've done for season ticket holders, and my mum is a season ticket holder at 91, is they're not giving them their seats. They're selling at lower capacity, and they're going to spread people out. And then when we have a vaccine and it's safe to go back, then they're going to move back to how the stadium was. But yes, I think they can under capacity constraints. And maybe for a highly popular team, it's going to be like Liverpool. It's going to be very difficult because the stadium is sold out every game. But for other teams, I think they'll be able to spread people out and distance. And I certainly hope we'll get that vaccine soon.
John Riding, you're very special with your public service to the Bank of England and the Federal Reserve as well. Of course, your work at Bear Stearns for over the years. What do you make first about the United Kingdom economy? There's whispers of austerity. There's, of course, the new Brexit diversion as well. How fragile is the United Kingdom economy?
Well, I think, as you said, most global economies have one major risk hanging over them, and that's the virus. But the UK has two. It has the Brexit negotiations, and you know it's been ongoing for a long time. But Brexit for real hits at the end of this year, and we're at a critical phase of the negotiations. And I think many of us have taken our eye off the Brexit ball with spending our time, you know, worrying and looking at the coronavirus numbers. So there is.
Well, let's talk about what's happening with Brexit before we turn to the economic data in the US. I know Tom wants to talk about the jobs numbers. Just briefly, John, we mentioned where cable is on the day. Bounced off session lows, 129.32 on sterling versus the US dollar. If you can, save us all in 45 seconds, John. What on earth is going on?
Well, to be honest, I don't know that we've had the realism in the negotiations that we need to have, and there's been I think a feeling on the part of the UK administration that they can somehow push through some relationship with the EU, and we have to remember it's a negotiation, and there are real issues that need to be resolved. I suspect they will be resolved because it's in everyone's self-interest, but I don't see the path to that resolution at this point, to be perfectly honest.
Well, and the backdrop has changed dramatically since the beginning of these negotiations. And to get to the economy, in particular, the reading that we're going to be getting on the U.S. economy, and it is representative of what we're seeing in many developed markets worldwide. We're going to get that JOLT survey at 10 a.m., the job opening survey. What will be the structural unemployment rate when the pandemic is over? How much higher will it be in the United States than it was pre-pandemic back in 2019?
Well, first of all, I think it's very encouraging, just talking specifically at the 10 o'clock number, that we've been seeing a pickup in job openings. That tells us that the labor market is trying to come back, as do the gains that we've seen in the employment numbers last Friday and in recent months. Having said that, the structural unemployment rate depends critically on whether you have a vaccine. If you have a vaccine, and people can become comfortable getting socially together, we can have a surveillance night out at a bar in New York City and have a few beers or whatever wine it is that Tom wants to drink. Then the structural unemployment rate should be, I think, not much different than it was prior to the pandemic. Yes, it will be difficult for some number of companies to come back, but we're seeing very high levels of business creation. People will start up. We're going to have a repricing of commercial rents. All of those things need to happen, but I don't see any reason for the structural unemployment rate to be significantly higher than it was pre-pandemic. It may take us a long while to get to that rate, but I think we can get down to 4% unemployment rates once we have a vaccine. If we do not have a vaccine, then the last mile is going to be very different. We're going to have 7/8 of a pie, and unfortunately, the service sector is going to be that slice in things like leisure and hospitality that's going to be very difficult to bring back. But I'm hopeful that these trials will go through. How long it will take, I don't know. That we'll have a vaccine. I'm hopeful it will be effective, and if it is, there's no reason for that unemployment rate to be higher in the future than it was pre-pandemic, but that may be a couple of years out.
Okay, so if we get the same low unemployment rate, will salaries stay the same, or will they be coming down? In addition to people actually getting jobs, they're just getting paid less.
Well, we're not seeing that in the data. Average hourly earnings have been higher. And this is a challenge for business. Now, structurally, part of that is because lower wage individuals have been disproportionately hit by this pandemic. They've suffered a greater portion of the job losses. But I think what we need to see is companies focus on productivity gains. And if that happens, there's no reason for the real wages to be lower than they were before. But it is an obstacle. We are seeing strong gains in real wages for those who are currently employed, not weaker. And that represents an obstacle to profitability. And profitability after the virus represents an obstacle to a return to full levels of economic activity.
John, what does the unemployment rate do here in the coming weeks, months, and quarters? I mean, give us a dynamic here of what we should see for unemployed America.
I think it continues to grind lower. Now, we had a surprising drop last Friday, and we did not have a drop for bad reasons, that is people dropping out of the labor force. In fact, we saw people returning to the labor force and labor force participation rising. So that is good. There's another measure of unemployment, which in some ways is difficult to understand, which is the large number of people, much higher than the number of people who are unemployed, and much higher than the number of people who've lost their jobs who are still on unemployment benefits. So there's really two measures of unemployment. But I think in terms of the unemployment rate, the U3 rate, I think that comes down probably by the end of the year. The way we're going comes down to around 7% or so. But once we have a vaccine and once we can start getting workers in hospitality and travel returning to work on a stronger basis, we've had some encouraging recovery in that area, then I think the unemployment rate can be down towards 5 or 6% by the end of 2021. And in fact, the unemployment rate is coming down faster, and the recovery is going a lot faster than it did coming out of the Great Recession.
Already below where the Fed saw it ending the year. They might have to update their forecast in the next couple of weeks, the next couple of months. John, most important question of the morning before we let you go. What do you think Tom Keene would think of Blackpool Tower?
I think it depends how much he'd had to imbibe. We might even confuse him and think he's in Paris and tell him there's the Eiffel Tower.
If we blindfold him and then release him in Blackpool. I found a hotel for you, Tom, the Grand Hotel Blackpool, 39 quid a night. You can quarantine there for 14 nights. It's about 550, 546 to be precise for the 14 days. I think you'd do okay out there, Tom.
I'll talk
then
to
we can go and watch a Preston North End game.
I think so. I think we can do this, but I'm not going to drink wine. I'm going to drink, a North End IPA or something like that. I mean,
oh, nice. What should we be drinking in Blackpool and Preston, John? What should we have?
Oh, well, I think Tom about hit it on the head there, and a good pint of Northern Ale would be the way to go.
There
John,
we go.
The pints in England are ginormous. They're not like a pint.
Well, we have
America.
20 fluid ounces in a pint in the UK and 16 in the US. So yes, they're 25% bigger. The fluid ounces.
See how he does it? That's why John Farrell. That's why he's John writing.
By
He's
definition,
got the
they
math
are bigger.
the pint.
Hey, John, great to catch up.
John
As
Riding,
always,
good to
John
see
Riding
you.
there of Breen
Be well,
Capital.
John.
Real conversation. Hey, and you, John. And send our best wishes to your
John
mum as
Farrell,
well.
when does the
Tom,
Premier-
real conversation.
Yeah. When does the Premier League start? I mean, seriously, they're the only ones that have gotten it right.
I think this coming weekend the football season starts
This is
in
good.
the United Kingdom, Tom.
Well, good. We'll have to pick up the kid.
Lisa can't wait to get stuck
She
into this.
can't. I mean-
We've got to find Lisa a team. Lisa, you've got to adopt
right.
a team.
All right.
Tom started with West Ham,
Okay.
but that was a little bit
I
too
moved
edgy
around
for
the
him when I
league,
told
yeah.
him I was
I'll
taking
call
him to
it around.
Stratford.
All right.
In
All right.
London. He didn't fancy it. He started liking North London and Tottenham, so he went with the Tots.
All right. Well, then
The
I'll call
Tots.
it West Ham Hammy.
Oh, you're going to go with West Ham?
Sure.
Don't call
I
him
think
Hammy.
Lisa's a Newcastle type. She's very Newcastle.
I'll do research. I'll do
Now,
extensive
Newcastle.
research all weekend.
Let me tell you, that's a night out. That's a night out for you, Tom. You'd love that. Have a quick Google of nights out in Newcastle, Tom. That would suit you down to the ground. Coming up on this program, David Rubenstein, Carlisle Group, and host of Peer to Peer from London and New York. This is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. Senate Majority Leader Mitch McConnell says the new Republican stimulus plan focuses on restoring supplemental jobless benefits and extending help for small business. The Senate votes on the measure tomorrow. It will cost as much as $700 billion. That's about a third of what House Democrats want to spend. AstraZeneca has paused its coronavirus vaccine after a person taking part got sick. That could delay efforts to speed an immunization. The drug maker says a trials participant developed an unexplained illness. The pause will allow researchers to examine safety data and maintain the integrity of the trials. And blackouts tied to wildfires are now spreading beyond California. Oregon's Portland General Electric turned off power for about 5,000 customers near Mount Hood. Dry winds were threatening to take down power lines and start fires. It's said to be the first time such a public safety shutoff has happened outside California. And President Trump plans to announce further reductions to the number of U.S. troops in Iraq today. That's according to an administration official. About 5,200 American troops are still in Iraq. CNN says that will be cut to 3,000. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
has been interrupted. Uninterrupted service is peace of mind. Kimmy from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
It does, as you say, have some catching up to do on that front. So we are expecting to see a little bit of strength coming through at the start of trade. How long will it last, though? The perennial question.
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
I do double down on helping other Black founders, whether it's fundraising, hiring, growth, product, whatever it is that they need.
We've put ourselves on the front foot again by adapting all the company, by resizing, by adjusting production rates, by adapting the supply chain as well to this new difficult environment.
It was really the current time that got us to make such a substantial and frankly public donation to, again, bring attention to the role of the HBCUs, the historically Black colleges and universities like Morehouse and Spelman, and to support their work because they do develop thousands and thousands of Black leaders throughout this country.
An important conversation with Reed Hastings, the Netflix founder and co-CEO. The gentleman who has recently introduced Reed Hastings will be joining us very shortly. A little bit later after that, Tom Keene. Looking forward to catching up with Mike Wilson and Morgan Stanley on the equity rout of the last week and a bounce back we see on the screen this morning.
An exceptionally important conversation. We've really tried, folks, to give you perspective here on the individual securities, Tesla, Apple, and the equity markets, on what SoftBank is believed to have done, and to talk to these strategists has been great. John Farrow with Mike Wilson will be very, very important conversation. This is a conversation of the day within this election season, without question, over what the wealthy, the haves, are doing with their money. Providing leadership on this, including his wonderful new book, is David Rubenstein, of course, of the Carlyle Group, in his peer-to-peer conversations. One of them has been with Reed Hastings. David, I want to cut to the chase. Mark Benioff of Salesforce, that Dow component, in a recent conversation with Bloomberg, was scathing about the lack of philanthropy, the clumsiness of the new rich of California, the new rich of technology. Reed Hastings seems to be providing real leadership here. Is his gift to Black universities, is that enough to be a game changer to teach the younger crew how to give away the millions?
Well, it was a $120 million gift, and it got a lot of attention, as it should have gotten. When I asked him about it, he said he's actually made very other large gifts. Actually, some are larger, but they just haven't been publicized. So I think he will have an impact. But I think Mark makes a good point. You have people that are now worth tens and 20s and 30s of billions of dollars, and you wonder what they're going to do with all that money, just piling it up.
Well, what do you do with it? I mean, this is something you with your success have faced. And, full disclosure, folks, Mr. Bloomberg, the founder of Bloomberg LP and this radio and TV property, has faced the same conundrum. Why is it so hard for some, and particularly these young technology types, to give money away?
Well, typically throughout the history of the world, people tended to give away money towards the end of their life, and they would live at the 60s, 70s, 80s. Now, a lot of people making money in their 20s, 30s, and 40s, and they haven't really expected to make this much money, and it just takes a while for them to give it away, I guess. But hopefully they will do some things. A number of these people have signed the giving pledge, as Mike Bloomberg has, and as I have, but I think it will take a while because the amount of money that people accumulated quickly is just unbelievable. For example, the founder of Tesla, he's now has a net worth of, let's say, $70 billion or $100 billion. He made it so quickly, it just takes a while to give it away and figure out what you want to do with it. But more philanthropy should be done for sure by all the wealthy people that now have money.
So, David, there are those who are looking to give away money, and then there are other people who are counting on continuing to work until they are very old because they need to support themselves. For those individuals, and speaking to your interview with Reed Hastings, can they expect to go back to the office? Can you tell us what Netflix's CEO had to say about that?
Well, I think Reed Hastings would like people to come back to the office, but they want to make certain that it's safe and so forth. He's been working remotely and actually from his house in California. Many CEOs like Reed Hastings recognize that people are not coming back to work really until there's a vaccine, until there's safe public transportation, and until there's a lot of child care for people who have young children. So I think it's going to take a while. I think you probably aren't going to see people back to work in full measure for another 6 to 9 months.
So he didn't ask you whether you have a Netflix subscription, and we've learned some private information about that, David, which you can or cannot share on this program. It's just us. But I do want to hear what he expects going forward. Was this a blip giving him a boon during this work-from-home era, or does he see this success parlayed into a longer-term establishment of streaming as the entertainment of choice?
Well, when he started Netflix, if people may remember, he basically had a system where you rented a DVD and he mailed it to you overnight and you mailed it back to him. And then he eventually got into the streaming business ahead of everybody else and caught the rest of Hollywood by flat-footed. He built the biggest streaming business, now with a market value of about $223 billion. And at one point, he wanted to sell the company for $50 million to then the biggest company doing this, Blockbuster, and they said no, they didn't want to pay $50 million for it. That's the best thing that ever happened to him financially.
David, how do you parse the Netflixes, and how did Mr. Hastings speak about the idea of spending, and not really generating profits? How do you partition companies that clearly make an income statement profit and those where it's not smoke and mirrors, but it's a little bit mysterious?
Well, people made fun of Jeff Bezos for a while. He was just building market share. They said he'd never going to earn any money. People made fun of Elon Musk, that Tesla would never get anywhere. And people made fun of Netflix, spending a lot of money on original content. Turns out that these entrepreneurs have had the last laugh so far. Clearly, when you can build market share, you can really get a lot of customers, and they get addicted to what you're producing. And ultimately, that's what's happened in Netflix. People are now, I won't say addicted, but people really love it. And it's really unique. Nobody else is really competing with them at the scale that they're able to produce and show their content.
David Rubenstein, one final question. This is quite a segue over to SoftBank and the latest derivative uproar that we've seen. Could SoftBank do what they did in investment management out of Abu Dhabi with the ex-Deutsche Bank crew? Could they have generated these derivative strategies with call options if they were simply registered in the United States?
I think it would be tougher, and I think a lot of people in the investment world were surprised by this, because it's a staggering amount of money. It appears about $20 billion of call options. Right now, it may be profitable, but it's a fairly risky thing to do.
David, let's leave it there. Thank you so much. Greatly appreciate it. And this is wonderful. David Rubenstein, peer-to-peer conversations. This with Reed Hastings of Netflix. Look for that tonight at 9 p.m. here on Bloomberg Television. Lisa, there's so much to talk about, including the advance in the market that we see today. We see Tiffany and LVMH and we've literally almost forgotten not a routine ECB meeting tomorrow.
No, and they're looking at a pretty uncertain recovery. Are we getting a stronger than expected one? Are we potentially facing a resurgence in virus cases? Right now, Bloomberg just publishing a story talking about some ECB officials coming out and saying that the economic recovery will be stronger than they had previously expected, potentially dialing back the need for more monetary stimulus this year. You're looking at German bonds, selling off just a little bit, not reacting too much. Hard to know, though, also how much support those officials will get with some of their peers.
Now, was there enough soccer talk today? I mean, should we ramp it up tomorrow further into the weekend's activity?
I need to do a lot of research. I mean, I got a lot of suggestions via Twitter of potential teams. It's a contentious issue.
Lisa,
I need to come up with one.
We get 10 times the response when you pony up on Premier League. People are gaga over this. I mean, Kit Jukes literally stopped working.
I'm doing
research.
I'm doing extensive research.
Keep it going. We love the research. Twitter on fire over Abramowitz's favorite Premier League team. We thank all of you on Bloomberg Radio and Bloomberg Television. We continue through the day. Greg Bottle on Bloomberg Radio. This is Bloomberg Good Morning Futures, up 29.
David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
That over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
From London and New York for our audience worldwide, good morning, good morning. The countdown to the open starts right now with 30 minutes until the opening bell. Here's your bounce back on the S&P 500. Equity futures this morning up 28 on the S&P. We begin with the big issue. It's the calm after the NASDAQ storm.
The move down in tech stocks, something that we've been expecting for a while.
A shorter-term disruption for the markets.
It's sort of recognizing that there has been a valuation problem in that sector for a while.
The valuations are absurd.
They've gotten expensive. This is sort of a healthy correction.
Too early to say, well, this is a kind of a great, dip buying opportunity.
This is a garden variety pullback.
A lot of these street numbers move higher by 10, 15, somewhat 20%, especially going into next year.
We still think large cap tech leadership, the leaders in big tech, is sort of the way to be positioned.
We're advising investors to trim that back.
The fundamental drivers and the re-rating.
Strong fundamentals.
That combination is why I continue to see a green light to own tech.
It is a garden variety pullback. Joining us now is Bloomberg's Sarah Ponczak. Sarah, 3 days, 11%, a garden variety pullback in 2020, apparently.
Pretty wild ride after the run that we had seen, certainly the worst streak since March. And if you look at NASDAQ futures overnight, they had fallen more than 1% at a point. However, now they are pointing decidedly higher. You're looking at the ride over the last 4 days. So clearly the sell-off was pretty steep. But now I look at my screen, NASDAQ futures this morning pointing up 1.4%. Even in the wake of that negative vaccine news, I do want to keep in mind, though, that even after the sell-off we've seen the last couple of days, the NASDAQ 100 is still up 27% in 2020. However, there were some nascent signs that the selling was beginning to tire. For one, take a look at volume. For example, yesterday, volume on the NASDAQ 100 was 337 million. Now, I want to be extremely clear that that is still a very, very high number. Keep in mind that the average for 2020 is closer to 225 million, and in a year as volatile as 2020. However, that was a slight downtick from the prior 2 days. Also, a lot of people pointing to the implied volatility markets. So VXN, that is the equivalent of the VIX, but for the NASDAQ 100. Now, last week, there was a lot of focus about implied volatility rising alongside stocks, especially in the NASDAQ 100. At one point, the spread of VXN to VIX, the widest in 16 years. Well, yesterday, we saw the opposite. We saw implied volatility falling alongside a near 5% drop for the NASDAQ 100, and that is not normal. So why? Traders point to a couple reasons. One, maybe the call options mania abating, and two, just the idea that a sell-off was actually already priced in to the volatility markets, John.
Is this a welcome back to the office for Sarah Ponczak?
As soon as I come back, markets explode with excitement, at least to the opposite way. Exciting on the way up. Now I come back for the downside. I guess this is my welcome back, John.
We're excited to have you back with us. Sarah, thank you. Good to see you.
Good to see you.
30 minutes away from the opening bell. Equity futures bouncing back. Julian Emanuel of BTIG saying investor optimism turning into FOMO in recent weeks. Writing the following, it's created extended conditions to historic proportions in a number of markets, from growth outperformance over value to extreme bullish options positioning and high-flying momentum leaders. But such momentum is rarely, if ever, sustainable. Julian, I'm pleased to say, joined us right now. Now, Julian, to understand how long it takes for these situations to clear, you need to be able to gauge, have an accurate diagnosis of what on earth has been happening in the last week. Are you confident you've got one, Julian?
Well, if you're confident you understand anything fully in 2020, you're probably going to be wrong. This is all risk-adjusted commentary. Basically, we had been somewhat uneasy the entire month of August with the rise in the NASDAQ, parabolic really, and the accompanying rise in the NASDAQ VIX, VXN. And to us, it felt a lot like the conditions that you saw in January of 2018 prior to the Volmageddon episode. What turned it? There are a lot of things that turned it. Obviously, we know that the public participation was very great. We also saw that institutions seemingly piled in to call options again in the month of August, which really sent things moving. But what likely turned it was the fact that we're here in September. And historically, when you've had extremely strong Augusts, they tend to be followed by weak Septembers and Octobers.
Julian, you mentioned the rise in volatility and the rise in equity prices. Do you reverse engineer that Are you expecting equities to pull back further and actually also see volatility come in as well?
So, John, it is entirely possible, and we saw that yesterday. What we saw yesterday with that kind of down move in the NASDAQ and a contraction in the VXN is very rare. It's not completely without precedent, and the signals tend to be mixed. But what it tells us is that actually the level of volatility itself is no longer the thing to focus on. What we are focused on is the skew. And part of what got us uncomfortable, really probably starting in mid-July, that showed the public participating heavily, was the skew whereby upside call options were priced at premiums to downside puts. And that's very rare. And what gives us pause that yesterday wasn't necessarily the bottom of this correction is the fact that skew did not steepen at all. So you didn't see fear yesterday. You saw, even though you had that sell-off, there's still fear of missing out there. And we think that needs to be corrected.
Julian, I hear some concern here, and I'm trying to work out from your standpoint, from your perspective, how you suggest people should hedge that concern right now.
Well, it is difficult to hedge using options, again, because, as you said, it's entirely possible that you're going to have a decline in volatility as the market grinds lower, if it does, in fact, grind lower. From our perspective, this is the kind of time where you need to look at your portfolio in a holistic sense. Likely you're overweight equities given the move, likely you're overweight technology, growth, high flyers. This is the time to pare back some of that exposure, and we use further weakness to rotate into some of the areas that have been left behind, specifically financials and healthcare.
Well, Julian, let me push you on that just a little bit. You said reduce exposure to equities, then you talked about a rotation. Is it one or the other right now?
We would prefer, for now, trimming a little bit of exposure, period. Our view is that you're likely in coming weeks to test the S&P's 500's 200-day moving average, which is currently around 3,100. Not that far from here. What I think we fail to appreciate, first off, is we're 4 days off the top, and people are already thinking that the move is over. You know, and we were on your show in February, perhaps a little bit too early to be buying. And so the right way to think about this is you really haven't seen, again, this fear of the downside. And to us, the buying opportunities tend to materialize when you get the fear of the downside. And you also have to remember that when the VIX is trading at 30, a garden variety correction is not likely to be 5 to 10%. It's more likely to be 10 to 15%, and, you know, call it 15 to 20% in the NASDAQ.
Is that what you're looking for right now, Julian? Yes. Those kind of numbers still, that much downside?
Yes, we do think that, you know, it's not likely to come all in one straight shot. It's likely to chop around because, again, what we've seen, certainly looking at yesterday's price activity, is that the public is still involved in the market and still in buy the dip mode. And we think you just have to clear that out, which likely is a process as we get further into September and into October, along with this reality that as we head towards November 3rd, things are likely to become less clear rather than more clear, and the market tends to be more uncomfortable on balance with greater uncertainty.
Julian, I have to say this all feels very cute and elegant and very precise, but let me go with you just for a moment. Let's say you get that kind of pullback. You want to deploy the capital once you get to your entry point that you've observed is the right place to come into the market. You're talking about rotating into the financials at that point. I'll catch up with Mike Wilson of Morgan Stanley, who has a similar view, at least the last time I spoke to him, that he expects a tech correction, then a broad-based rally off the back of that. Julian, why the financials? Why, when you do start to put capital to work, why there?
Well, because if you look at it, if you assume that 2021 is likely to be a year of economic recovery, and you look at financials, which are very, very depressed valuation-wise, and you put that all together and you think about the fact that the Fed has just recently publicly blessed the idea of higher inflation, while at the same time committed to holding the front end of the yield curve essentially at zero for the foreseeable, probably more than the foreseeable future. It's a recipe for an upward sloping yield curve, a resumption of higher inflation expectations, and those are very good on balance for financials.
Did you get kicked out of the house this morning, Julian?
No,
Did the
well,
family
John,
throw you into the back garden?
I wanted to push back on Tuscany, that's all. And this isn't Tuscany, but after 6 months of shelter in place, we're doing a slight change of location for a few days out on the North Fork in Long Island. It's a beautiful morning.
There is a rumour that I may or may not have been in Tuscany for the last 3 weeks. Julian, it's a rumour I won't confirm or deny at this point. Great to catch up with you, sir. Julian Emmanuel of BTIG. Coming up on this programme, the initial speedy recovery from COVID-19 lockdowns, losing some momentum. That conversation is coming up next with Morgan Stanley's Mike Wilson. In the equity market, 20 minutes away from the cash open. Equity's doing nicely. The S&P near session highs. The NASDAQ futures up by 190, positive 1.7%. This is Bloomberg.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
The Boston Symphony Orchestra presents BSO at Home, a collection of concerts, at-home lessons, and behind-the-scenes stories to enjoy while you stay at home. Learn more at bso.org/at-home.
We need a much more effective strategy that is not about locking down whole countries. By all means, I mean, the British are great. They will lock down their own internal regions, but when it comes to other countries, they then lock down entire countries. It's not sophisticated. And I think what is the real challenge is once we get to kind of September and October, the schools go back, we need business people to start moving again. And they can't move. You can't begin to resume business travel.
Ryanair's Michael O'Leary saying the government's ineffective policies are adding headwinds to the airline industry and slowing down the economic recovery. A couple of months ago, there was a social stigma attached if you were a CEO to come out and say the authorities need to reopen these economies, get people back to work, get business going. That stigma's not there anymore. These CEOs feel like they've got something to say, and they're willing to say it. Joining us now is Bloomberg's Mike McKee. Mike, it's quite a change in the last couple of months. More important voices coming out and saying, you've got to open up, get the testing regimes in place, get these economies, and get people back to work.
Yeah, still, John, Mr. O'Leary is likely to be disappointed because he's got two problems. One, can people fly? That's what he's talking about. And two, do they want to? You can lead a horse to the airport, but you can't make them get on the plane. Business travelers still reluctant until we get some kind of vaccine to get on a plane and go somewhere and stay in a hotel. Company controllers also kind of liking the idea of Zoom meetings as opposed to those airline travel bills. Here in the United States, you take a look at what we have seen in recent weeks in terms of reopening the country. You can see there was a bit of a spike in airline travel. That's the white line there over the past weekend, but it wasn't business travel. That's the holiday weekend travel. And you can see right before that, we saw a drop. The other indicators, retail sales, and we're looking at also the mobility index. Those things, restaurant seating, those things have been rising, but they're just grinding higher at this point, still below where we were. Economists say the low-hanging fruit has been picked, even if you open up the economy. We saw job gains moderate in August, of course, on Friday, and jobless claims rising again last week. And let me show you something else. Here's another worrisome sign. Oil prices have been tanking. That's in the markets today. And that accompanies a drop in demand because price is a function of demand. Now, the summer driving season is over, but the demand drop started before the end of the summer. So something to keep an eye on this week. Not much else to trade on from a fundamental standpoint. You got Joe Biden out today with an ambitious plan to try to get people to make it in America. That's going to be his theme for his comments in Detroit today. Other than that, a pretty quiet week on the economic front. The biggest news that we have is on Thursday with the ECB meeting. No change expected, perhaps more on their framework review after the Fed's announcement. Their economic forecasts are said to be a little more optimistic, although the second COVID wave now seems to be gaining steam there, so that'll be interesting to hear what they explain about it. And, of course, we have jobless claims. That's the one everybody watches every week. Third quarter growth, going to see something of a strong bounce, but after that, things should slow down. And so there's going to have to be some thought about how we trade from there.
Mike, let's just pick up on the ECB just quickly and get to euro dollar. Bear with me. Big pop in the last 30 minutes or so off the back of that story that we put out about those forecasts. Euro dollar 118.14, took a sneak peek at 120 last week, got a slap from the ECB chief economist, a bit of verbal intervention. They'll be treading a fine line tomorrow, Mike, if they're about to say they've got more confidence in economic recovery and at the same time don't want that euro pushing higher.
Yeah, well, the Bloomberg story also says that the revisions to the growth forecasts are going to be small. Any kind of optimism, obviously, is something that the markets want to jump on at this point. But people have to be careful because we saw this happen in the United States when the economy opened up in May and June and the economic indicators started to rise. And then we had another spike in COVID cases, and they're starting to see a real spike in Europe that could affect whatever forecast the ECB comes out with.
Mike McKee, thank you, sir. Morgan Stanley weighing in on the recent volatility, writing in a note the following. This is still a bull market with lots of opportunity in single stocks. We continue to believe the best hunting grounds for such stocks are smaller companies levered to a further reopening of the economy. We continue the theme with Mike Wilson. He joins us now. Mike, fantastic to catch up with you, sir, as always. This recovery, Morgan Stanley has been very bullish relative to the rest of the street. Do you like what you see so far, Mike?
Well, I do. I mean, from a fundamental standpoint, John, I got to tell you, I mean, as you said, we've been pretty constructive on the V-shaped recovery. Even we've been surprised at the persistence and the explosiveness of the economic surprises and, of course, the earnings revisions that have come through, which is core to our thesis that this is a typical, recession and recovery. Just it's happening at light speed, and that V-shape is actually even sharper than what we saw post the great financial crisis. So we love what we're seeing in the fundamental side. We got a little concerned about a month ago. As you recall, we thought things were getting a little bit overcooked. Our timing was not great on that because obviously August was even better. But now, of course, we've learned why that's the case. There's been some very speculative activity in the options market that's now being wrung out. So we like that now, too. We think taking out some of that speculative behavior is necessary and in line with our view that should happen, and then we can have a broadening out. Now, very near term, we have the risk of obviously this sort of fiscal cliff, and the negotiations are stalling out. That's a big deal. That doesn't happen. If we don't get CARES 2, we got a serious problem. Now, we think that'll happen, but the market has to think about that and work through it. And, of course, the election uncertainty, and then the reopening story itself is, schools are back, and, who knows if there's going to be further lockdowns. And There's a political angle to that, of course. So those are the risks in the near term, but ultimately we think that's the wall of worry. We power through that, and next year, the bull market will resume in earnest.
In the recent research, Mike, something jumped out to me. It was the index level range bound. That's the call from you now and the team at Morgan Stanley. Why is that, Mike?
Yeah, so let's make a distinguishment, John, between the market cap weighted S&P 500 and the equal weight S&P 500. The market cap weighted is what everybody sees on their screen. Obviously, it's very top heavy with a handful of companies, and that's been powering higher. And we think, part and parcel with this technology correction, that should take a break. And we laid out in pretty good detail why we think that's the case. We think the multiple expansion has already happened, as it typically does. As earnings trough out, the multiples expand. And then once earnings go up about 10% from the trough, then multiples actually come back down again as rates move higher. And we see that transitioning over the next 3 months. So we see multiple contraction over the next 3 months, which will hit kind of the larger cap companies the hardest, because that's where the multiple expansion has been the greatest and where the earnings revisions have been quite good. And then, but the earnings story is the one that people need to pay attention to. The earnings story is very real and will power us through. And that's where the equal weight S&P can tell the story, which is meaning the average company has more operating leverage to this recovery than, say, the large cap behemoths who have already benefited from their scale and benefited from the lockdown itself. They've been able to power through that. And so the revision factors there won't be as great. So it's a bit, it's a bit confusing to kind of think about it that way, but this is very similar, John, to what happened in 2000, 2001, which is where the S&P 500 market cap weighted went down 30 or 40%, and the equal weighted index was up. This time, we don't expect the market to go down 30 or 40%. We just expect it to kind of trade sideways for a bit. But there are many, many stocks within the S&P 500 that maybe people aren't paying attention to that have tremendous operating leverage that can actually make new highs. And that's how we're positioning ourselves.
So, Mike, let's explore this further. I've been lucky to get a lot of time with you over the last 9 months or so, and I've been on this journey with you as you've made these calls. And one thing you said very, very early on was to reflect on the historical parallels and talk about that classic recession playbook. Mike, as we continue this journey, what are you learning as we go along?
History repeats. Don't ignore history and these cyclical patterns. They are powerful, and more importantly, the business cycle really determines the majority of how you want to position yourself within portfolio construction. So, as you know, John, over the last couple of years, we've been defensively positioned back in 2018-19, right, looking for kind of classic end of cycle behavior, and that means defensive bond proxies outperform. And that, we got a little bit of flack for that, but that's exactly what happened. And then, of course, in March, we flipped the other way and decided to go more pro-cyclical and put more risk on and get out of the bond proxies. And that's been the single most important decision to have made as a portfolio manager. So, while there's all this attention around growth versus value, we think the bigger sort of top-down call to have had been made is cyclicals versus defensives, right? Defensives outperform cyclicals at the end of a cycle, into the end of the cycle. And of course, cyclicals outperform defensives coming out of that recession. And I got to tell you, it has played out to a T once again, illustrating that the business cycle is a dominant factor. Yeah, the Fed's important, obviously, politics are important, all that good stuff. It has impact, but the reality is the business cycle rules the roost.
And Mike, always great to catch up with you, sir. Let's continue this conversation as well. My best to the team at Morgan Stanley, Mike Wilson there, the Chief Equity Strategist. Coming up on the program, the analyst action you need to know. That'll be next in our morning calls. And later, MFS, I'll get it all out, MFS Portfolio Manager Henry Peabody will be joining us. I hope he forgives me for that. That's coming up very shortly. And the market's right now 7 minutes away from the opening bell. Equity futures rebounding here, doing nicely, up by 1.92% on the NASDAQ. A rebound after a 3-day rout. This is Bloomberg.
this is a step in the right direction. Perhaps it's a harbinger for more changes in the future, like the completion of the banking union.